Good morning, everyone. We're now live in the meeting, so just want to welcome you all to today's meeting of the Local Pension Committee. As usual, this meeting is being broadcast live to the public. For those not able to watch live, the webcast will be recorded and made available for viewing on the County Council's website, YouTube website after the meeting. Before we begin, can I please remind everyone to only turn on their microphones when you wish to, or are invited to speak. We've received apologies from Mr. Henry, and also Mr. Whittle is online, so he can take part in the meeting, but he isn't able to vote if there was a vote on any item. And and Richard Warden, who's from Hymans, the actuary, so I'm going to remember that word eventually. He's online as well. So, okay. So we're going to move on to item 1 on the agenda, which is minutes of the meeting held on 27th of June. And just want to move that the minutes held, taken as read, confirmed and signed. Is that agreed? Sorry, Mr. Piper, is that an agreement? Or yeah, that's great. Thank you. All right. So now we're going to move on to agenda item 2, which is question time. We've received a question from a member of the public, Mr. Rupert Sims. The question and the response has been circulated to members of the committee prior to the start of the meeting, and it's going to be taken as read. This has also been published on the council's website for information, and I would like to remind all members we don't have any discussion on this question. I believe Mr. Sims isn't actually present. He's not in the room and he's not online. So therefore, we're going to move on. There is no supplementary question. And we're now going to move on to the... We're going to move on to number 3. Sorry, there's a bit of blurb there if there had been a supplementary question. So apologies for that. And questions received by members under Standing Order 7.3 and 7.5. No questions have been received. So we move on to item 4. There are no urgent items. Move on to item 5, declarations of interest. Do any members have any interest they need to declare at all? Aside from the ones they've already declared on the members' interests? No, okay. So then going to move on very swiftly on to item 6, which is the report of the Local Pension Board Annual Report 24/25.
Unknown participant is now exiting.
19 to 30 of the agenda. The report was approved at the Local Pension Board meeting on 3rd of September, will be taken as read. Committee is asked to note the board annual report for 24/25. Is that agreed? Agreed. Okay, thank you. The next report is the pension fund valuation, indicative whole fund results, draft funding strategy, pages 31 to 100 of the agenda. And Ian Howe, it is there. A pensions manager is introducing this report. Also with Ian is Richard Warden, who's online from Hymans Robertson. Over to you, Ian. Thanks very much.
Thank you, Chair. Good morning, all. Good morning. This is the next stage of the valuation. We've been working on the valuation, as you know, for about a year. We're now at the point where we're looking at the funding strategy statement, which is an element of the valuation process and is the kind of the nuts and bolts that sit behind the valuation effectively. So what we've done is we've looked at the previous funding strategy statement, which was back at 2022, and we've made a few changes which are detailed in the report, and I'll go through those. The thing I just want to mention though before I start on the funding strategy statement is the result of the whole fund valuation. We've had that back from Hymans. The position is 140% funded as at 31st of March 2025, which is an improvement from 105% at March 22. So that's a significant increase, which is obviously welcome. But that then brings its own sort of challenges that we're working through, and that's what basically I'm presenting within the funding strategy statement. So if we jump to the funding strategy statement, if I may, the The points to highlight are in my report from sort of points 24 down. So if I just kind of cover those briefly, if I may, and then we can take any questions at the end if that's okay with colleagues and members. Table 2.2, that is the table that lays out effectively how contributions are calculated. So that is split by groups. So the table lists all the employer groups and the approach taken in the following areas, and that's the funding basis, the target funding level, the minimum likelihood of success, the maximum time horizon, the primary rate approach, secondary, stabilised approach, treatment of surplus, recognising covenant, and phasing of contribution changes. So that's the key area where the employers will particularly be interested, because that's the bit that effectively works out how we assess those individual employers. We do it in groups, so we group them, but then within that we can have the ability to look at individual employers within that if we need to. Table 2.5 in the FSS is new, and I just want to just briefly touch on this bit because it's new. This is the only section in the FSS that is new. We are experiencing some inquiries from employers who are looking to move from a kind of an open agreement, which allows all their scheme members into the scheme, to a closed agreement. So effectively close the scheme to their new employees. We haven't experienced this before. So this is a new area, and what we're proposing in that table is the way we will move from an open to a closed employer, to effectively move the way that we would assess that to a more rigorous approach as they get towards that closed status. So move them towards a low risk methodology, which effectively is designed to secure the fund and protect those benefits moving forward as we still have to pay those benefits. So it's how to protect that funding. The section 2.6, this is just explicitly stating now we don't have an alternative investment strategy, including a facility for buy-ins or other insurance policies, insurance solutions. That's always been the case, but we're now making that explicit. Section 2.8 is reviewing contributions between valuations. The fund we'll consider an early review of employee contributions as detailed in Appendix H. It's always been the fund approach, but again, that's now more explicit. Admin, Section 2.1, admin authority discretions. Officers recognise individual employers may be affected by circumstances not easily managed within the FSS. So we will consider cases on a case-by-case basis, as I said. And there is flexibility to employ contributions where additional security is added, and that's particularly for the universities, who we've already established previously are one of the highest risk groups within our fund at the moment. I won't necessarily touch on all of the others because most of those are just making more explicitly detailed what we already cover within the FSS. We're looking, if I may just jump ahead to Appendix E, and that's the assumptions for cessations. We are looking at how we can make that a little bit more robust to strengthen how we can sort of effectively retain some surplus when employers do leave, and that's partly being prompted by employers looking to close the scheme. We have proposed some changes into the FSS on this, but we're going to look into this further and look to try and further strengthen this particular area. So I propose to bring something back to committee in December regarding that particular point. The investment strategy statement, which is discussed at point 37 in my report, we normally bring the ISS at the same time as the FSS, but because of the ongoing changes around Fit for the Future consultation and the pensions bill, it's been considered appropriate to bring the ISS to a later a later committee because of the changes that are afoot in that particular area. The next stages after this has been considered by committee, I'll also share it with the board, and then we will start a consultation with the employers in November. By November, I'll have the indicative employer contribution rates, which I'll then be able to share with individual employers. And at that time, I'll also share the FSS and open that consultation up with employers to take their views and thoughts on this document. That's all I propose to say at this point, Chair, but obviously happy to take any questions.
Okay, thanks for that, Ian. No doubt there's quite a lot in that, some of those things. Mr. Cartwright.
Thank you, Chairman. Good morning, everybody. It's probably the most difficult time ever. Well, certainly there's been phases of difficult times for funding, given the overall economic climate and the environment. 140% over 105 is absolutely welcome and testament to how well this scheme's funded. The question regarding that, though, is that headline figure is fantastic, and I don't want to detract from that. But the question that arises out of it is employers could be thinking that their reduction is going to be higher than contribution reduction is going to be higher than what they would ordinarily have expected to, because the headline figure is so good. That doesn't translate, unfortunately. I wish it did, but it doesn't. So it's how we manage that expectation. It's no fault of our own. It's just an expectation because the headline figures are so good. The second one is in relation to the FSS, which I'm sure you're referring to the final salary scheme, and being open to closed employers. Two questions around that, if I can. How does that affect existing employees that are on the final salary scheme? Which leads into the next question is, I understand for new employees not having the ability of a final salary scheme, they're not affected by it because they never had it in the first place. But two questions flow from that. How do the existing employees, are they affected by the final salary scheme, effectively closed from that date and in a new scheme? So they've got two schemes running, one that was under the old terms, one under the new terms, or do they have to, or do they stay basically on just a final salary scheme because that's what their terms were all along? A bit convoluted, but it's understanding the transition between those two, and I'm not bothered about new employees because they sign up to and they get whatever they're given, and that's the real world. But it's existing employees I'm trying to tease the question out of, Chair.
Thank you. The first point about managing expectations for the employers, I think you hit the nail on the head in truth on this point. We've started dialogue with, we've had dialogue with the stabilised employers. So that's taken place already. And the expectation with those employers is fine. That's the boroughs, districts, police, fire, that sort of group. So that group are covered. I've started conversations with the universities. So I'm having discussions with them. The other groups, I'm having dialogue, very early dialogue with those employers. And that's only really those that have asked me so far. So some of the academies, some of the colleges, there's certain employers are asking. But we're working on a model with the actuaries that will give some back but still protect, and that's what we're based around that 120% buffer that we've talked about before. So some employees will start to see a reduction, but it won't be a sudden drop reduction, which is I think the point you're probably making. So it's that communication and conversation that we're having with them, and we're building communications around this point actually as well. So when I send this information out in November to the employers, we'll have some prepared comms on that specific point. So we're working on that, but in preparation, I'm also having those conversations as well. So we'll work through that. Is that okay? In terms of the second point, that the members, the existing members, it really depends on what the employer ultimately chooses. If the employer chooses to just close the scheme to new members. Those existing members will see no different. Their benefits will remain in the scheme and they will just continue until they leave and retire. So there's no impact. If an employer though goes the next stage, which is to actually close the scheme and remove existing members, I'm not proposing they would do this, but if they did do that, it would have an impact on those existing members because they would then come out of the scheme and they would then be treated as leavers. So we would have to calculate their benefits and we would close those pensions for those individuals. Depending on their age, depends on whether they can claim them at that time or whether they're preserved. Those members would then have to start or propose to start a new scheme with their employer if they chose to. And that would be a different scheme to the one they're in now. The employers we're talking to, we don't expect them to do that second step. I think what they're likely to consider that they're going to do is close the scheme to new members. So the point that I've just mentioned doesn't come into play. The existing members will not be affected. It will just be new members would then go into a new scheme. Is that okay?
Mr. Cartwright?
Just to come back on that is the norm and what you'd expect, and there'd certainly be problems with employee relations if that wasn't the case. But I'm it's not for now, but just kind of understanding how many are likely to take that more drastic step, because we need to be prepared for it for the fallout too. That's all. But great explanation. Thank you.
Thank you. Mr. Piper?
Thank you, Chair. I was just looking at the report, and on page 49, where you have a breakdown of asset class and allocation. Just below halfway down, you have one as credit, including government bonds, and two below that, you've got UK government bonds. So have we double counted UK government bonds?
Ulish, do you want to comment on that?
Yeah. Ulish?
Yeah, thank you. I don't think the headings are helpful at all. I think the credit there probably refers to one strategy. It's called multi-asset credit. UK government bonds are separate there, and that 3.5% relates to UK index-linked bonds. So yeah, we shouldn't say credit including UK government bonds in that table.
Can the necessary amendment be made then? Yeah, so that'll be amended. Thank you.
Thank you very much, Chair.
Thank you. Vipul?
Hi. Are you able to say which employees are considering closing the scheme? Oh, not closing the scheme, but sort of closing it for new joiners.
I'm not able to discuss that. These conversations are taken in confidence at the moment, and the reason that is the staff at these employers, or that they're not aware of these proposals yet. Some of them, so I'm not. No.
Okay. Until they make a decision, I think and they've got to go through staff consultation if they are going to do that anyway, and if there's trade unions involved as well. So a long road to go there, I suspect. Nick?
Thank you. Just a couple of points, really. First of all, I support the idea of beefing up the protection of the fund for leaving employers, because that just protects the funds, and it also protects existing employers as well who are staying in the fund. So fully support that. Question in terms of expectations, which is important, which Mr. Cartwright raised and you read. A lot of that 140% is really not extra money we've got. It's different expectations of future growth. It's not actually within that. So was it 6.1%? I think it is, compared to 4.4%. That's most of it, I think. Within that, in terms of that. And the other question, which is sort of technical question for you, Ian, if an employer does say, right, we're closing it to existing staff, are staff over the age of 55 or soon to be 57 entitled to take their pension without actuarial reduction?
No.
Okay.
Can I come back?
Yeah, Ian, please come back.
No, they're not on that, Nick. It's because they're not actually being made redundant. So it's a contractual change, not a redundancy arrangement, so they wouldn't in that regard. No, they'd be entitled to take benefits voluntarily, but with a reduction, not without the reduction. The point you make about the funding improvement, yes, it is, a lot of it has been driven by the improved proposed funding rate at 6.1. Yeah.
Okay. All right. Happy with that? Okay.
Continue.
Declan.
Just worth a couple of points for context. One is that the stabilised employers that Ian sort of described, sort of the county councils, etc., we legally have to offer LGPS. So even if employers are thinking of cessation, this isn't kind of the fund's going to sort of shrink to sort of an unsustainable level. We're always going to have, I don't know, 2/3, 3/4 of the fund is kind of legally required to do it. So we're always going to be sort of a pretty meaty size. The other point to note is we've got 200 employers in the fund, a mixture of public and private sector. So there's pretty much always somebody talking about sort of closing the scheme to somebody other. So I wouldn't read too much into it, but it is important we get our protections right, because we can't choose who potentially is going to close the scheme. It's down to them. But just to maybe give a bit of comfort, there's always going to be somebody talking about it, just because we've got so many different employers within the scheme.
That's great. Thanks for that, Declan. Anybody else? No. Okay. I mean, I just wanted to say about the point you made about the employers potentially looking to close the scheme to their any new employers. I mean, that's not a new phenomenon. It's been going on for a couple of decades, I think, certainly in private and sector. And I know that certainly in public sector, a number of local authorities and other employers have looked at it and have tried to implement it, if I can put it like that, and not been terribly successful at it, because they've come a cropper on some of the legislation framework about equal pay and TUPE and all that sort of stuff. I understand. So it's not terribly easy for employers in the public sector to stop offering the scheme. I think that's the conundrum they have, because I know ones that have done it and it didn't work out very well. So and certainly if they're trying to transfer the whole of their staff in, that's a very much more expensive thing to do, because you can't. Anyway, it gets very complicated, as you know, Ian. I'm not trying to tell you. I just know it is. It's terribly complicated and very expensive. So we certainly don't want anyone to leave, if because that would be good. And also, not being funny, but if you're an employer and you offer reduced terms, reduced benefits to employees, then actually, whilst other people are offering, perhaps a better package, then actually, if there's a choice between one over another, potentially employees are going to go to one that's offering a better package. So it is market led in terms of, and if you've got a tight labour market. Anyway, that's not our problem. Okay. So recommendations. Committee's been asked to note A, the whole fund valuation rate of 140%, which I think we've all understood that. B, the draft funding strategy statement with the tiny amendment that that's got to be made in that table. And C, employer consultation on the FSS will commence in November this year once the indicative employer rates are available. So I'm happy to move the three recommendations. I just need someone to second that. Mr. Grimley, is that agreed? That's agreed. Thanks very much. And I'd just like to welcome Councillor Denny to the meeting. Thanks very much for getting here. So we're just going to move on to item 8, which is the Pension Fund Annual Report Accounts for 24-25, pages 101 to 216 of the agenda. And we have Simone who will introduce this item. Thanks very much. Over to you.
Thank you. So this report does seek comments, or it's for consideration on the Pension Fund's annual report and accounts for 24-25. So it is backward looking, and it's already been considered by Pension Board as well. You'll see the report is very long and very complicated, so I'm not necessarily going to try and cover it all in detail, but just pick out a few key points. You'll see from the intro that the fund was valued at the end of the year at just over 6.6 billion. We have over 100,000 members and around 200 employers. Over half of the assets are pooled with LGPS Central. So that just shows some good progress towards pooling by March 2026, which is now in line with the government's revised policy. The report also contains some very extensive information on financial performance, but again, it is backward looking for 24-25. It starts with the draft accounts, the draft statutory accounts, which are on page, I think, 125 of the agenda, and then it continues with the outcome of investment performance as well, which I think is on about page 159 onwards. You've then got an overview of how the fund has been managed over the last 12 months. That's in terms of administration of member benefits, and you've got a whole range of KPIs in there, which gives the committee some assurance over that performance. And you've got a number of KPIs at Appendix A as well. You'll see from that McLeod does continue still to have a big impact on the admin of the fund, and you can see the impact of that through some of those KPIs. There's also an update on training that the board and committee have undertaken, and also attendance at meetings over the previous 12 months as well. So there is a statutory requirement for this report to be published by the 1st of December following each year. The accounts are currently being audited by Grant Thornton, who are the council external auditors, and the committee will have an update once that external audit has been completed and the opinions received. It is progressing well and is almost complete, actually, which is obviously good. And so the report itself is only draft at this stage because we have got until December to finalise and publish. And you'll see there are a couple of areas that are still being finalised, and of course we do need to wait for the auditor's opinion as well. That's all I'll draw out from the report. But obviously happy to take questions, and any comments from the committee. Welcome. Thank you.
Yeah, thank you, Simone. Before I bring you in, Mr. Cartwright, I just wanted to, remiss of me to say that Dr. Bloxham has joined the committee. He's replaced Mr. Krug, who's obviously gone on to become deputy leader of the council. So welcome, Dr. Bloxham. It was remiss of me at the beginning not to welcome you. So thanks very much. Moving on to, if anyone's got any queries, Mr. Cartwright.
Thank you, Chairman. Just on your last point, can we thank Councillor Cook for his involvement for the short time he was here. Like you say, he's gone on to bigger and better things. Technically, not necessarily, because I treat the pension scheme as being important. Anyway, the questions relate to 50% of pooling, which is great in one sense, because obviously it reduces costs and exposure. But what is the government's target in percentage for pooling for schemes, and by what date? That's the first question. And the second one is around the training. I've said it before and I want to repeat it. The training programme that's offered is excellent. There's a substantial offering to members should they take it up, and it's only not doing so that means you're not trained. So I want to commend the training. Unfortunately, this goes in cycles, though, because as you get new members, you've got to start them all over again. I remember I've lived that journey in a very quick succession from when I joined. So commend the training itself, but obviously the training cycle is difficult because new members come in and then they need to start afresh. But 10 out of 10 for the training programme itself. Thank you, Chair.
Thank you, Mr. Cartwright. Simone, can you answer the first question?
Yeah. So in Bulish might come on this as well, but in terms of pooling, the government's Fit for the Future consultation requires essentially full pooling by the end of March 2026, and we are making them progress with Central towards that. But Bulish might have.
Yeah.
I can add a little more. So 100% is the aim, but we're about 58% pooled at the minute. What we intend to do is pass oversight to Central by the 31st of March 2026 for the remaining 40 or so percent. Over time, and we can ask Central when they arrive later today, those other mandates will run off and then they'll be reinvested into wholly Central products. So, over time, you'd imagine we get 60, 70, 80% really pooled with Central.
Yep.
Come back on that, thank you, Chair. So that's a really accelerated process between now and then to get from 50 to 100%. Because obviously, you said 58%, so to get to 100% from now, between now and 2026, that's a really accelerated process between what we've currently been through. I'm not making a criticism, I'm just making the point. It is really accelerated in the movement to full pooling to what we've achieved in the past, by no fault of our own, just by legislation.
There will need to be careful transition of that, and as Bulesh has said, where where movement towards pooling might create extra costs, or needs to be consideration about doing that over a longer timescale so that those costs are managed. But as Bula said, it might be a question I want to ask Central when they come in.
So yeah, that's great. Thank you. So just to answer that point, you're absolutely right. And that point has been made repeatedly to the government by all the pension funds, the LGPS pensions administrating authorities around the country, some of whom have less pooled products than we do. Some have slightly more, because the timescale involved is so short, as you rightly say. So there is a workaround which has just been explained, which is we give oversight to the pool over what we do, and then over time things will transition into one of their particular products. That's why. Yeah, do you want to come back, Bullish?
Thank you, Chair. I think that's the important part, Chair. The oversight piece, it doesn't require us to sell down any of our existing mandates. You know, the other 40 or so percent doesn't require us to sell anything down. It just passes oversight to Central. We're not incurring any unnecessary transition costs.
Are you okay with that, Mr. Piper?
Yeah, a bit of a small point. It's a very complex report. All of the reports today are very complex, and they take an awful lot of cumulating to get them together. But just to make some of the things a little bit easier to read, I find that the tabulation of some of the figures could be a little bit easier. With some of them, I think on page 171, in the table there, all the figures are tabulated to left justification, which means that an item which only has one in it starts at the left, whereas the thousands also start there. It would be easier to read, I think, if tabulation could be more either to the right or to decimal point. I know that's a very petty comment, considering the amount of work that's gone in there, but it would make it a little bit easier to read. You're nodding there as if to saying, is this a petty comment? Yes, I.
Thank you, Mr. Piper. Simone?
I was just going to add, it is a draft report, so we can have a look at the presentation before we finalise it.
Yeah, okay, that looks like that's just a formatting issue to me. Because I've looked at some other figures and they are right, justified. So, yeah, I'm sure it'll all be sorted out at the end. Right, has anyone else got any other points they want to raise at all? Can't see any. So basically what we are being asked to do is to approve the annual report and accounts of the pension fund for the financial year 24-25, subject to external audit, and to B, note the Corporate Governance Committee will receive the external audit of the 24-25 Leicestershire County Council Statement of Accounts, Annual Governance Statement of Pension Fund Accounts. I'm happy to move the recommendation. Can I have a seconder? Dr. Bloxham, thank you. Is that agreed? That's agreed. Thank you. Okay, thank you. So we're going to go on to item 9, which is the valuation of pension fund investments, which is pages 217 to 240. And Bullish is going to lead us through his presentation on this. Thank you.
Thank you, Chair. So this is our standard quarterly report, and the purpose is to provide the Pension Committee with an update on investment markets, total value of the fund as at the 30th of June 2025. So we start off with the standard market performance and outlook. So points 2 to 10 talk to the general market review. With a table at point 10 showing developing country inflation and interest rates. Most moving downwards. The only exception with Japan moving upwards. I think that's their first increase in about 17 years. Point 12, no rebalancing activity over the last quarter. The last rebalance was actioned in March 25 when we added £25 million to the LGPS Central Investment Grade Bond Fund. Point 13, the fund is now in a better funded position. Ian talked about this earlier. Hyman's draft report reports a funding level of 140%. Important to note that funding levels can reverse. The current high level affords the fund an amount of ability to navigate volatility in the value of the investment assets and should have a reduced effect on employee contributions than if the fund was on a lower funding level, and therefore may need to increase employee contributions. Point 14 talks about how the fund assesses its strategic asset allocation annually alongside its investment advisor, Hymans Robertson at the minute, and takes a measured approach to understanding the investment markets to make considered changes to investment strategy to avoid moving rapidly to areas where investment trends might be short term. At point 15, that's points A, B, and C, we've got a graph that was used last quarter. It's still relevant now, so I took the liberty of adding it again. And what it's showing there is how equities have outperformed inflation by quite a fair margin over the long term, but less so over the last 2 decades. So just plus 1.2% over inflation over the last 2 decades. What's important here is, however, the alternatives to equities, bonds and cash, for example, have produced negative returns over the last 2 decades. And the point here is we might come under some pressure over time to reduce the risk the fund takes or to move to different strategies. It's just being mindful of, the current climate of where certain asset classes or groups have performed. Point 16 summarizes an appendix. Appendix A is a Hymans Capital Markets Review for June 2025. I've picked out some highlights across equities, government bonds, corporate credit, and UK property, but the full appendix is within the pack. Any questions before I carry on to performance? Okay. 17, and the usual summary of a global asset class performance over various timeframes. The since last valuation column, the last column in that table, has been reset to the 31st of March 2025. So since last valuation refers to the actuarial valuation. So that has less meaning now. It's just the last 3 months. The standout classes here are, and they're the same that we've seen for the last few years, I think, listed global equity, US listed equity, private equity, and gold. And the first two exhibit quite a high degree of correlation, as you'd expect. A side note is that 2 of our managers within the fund are able to invest directly in a couple of these areas, gold, for example. So we have 2 managers who can get direct exposure. We do have other equity managers, global active equity managers, who could choose to indirectly get exposure to that area as well. Point 19, 18 and 19 actually, portfolio changes during the quarter ended 2025. No changes other than the normal capital calls we have for private markets. The net effect on cash quarter on quarter has been a small increase. We're at 569 million now, and we've got more information at point 22. I won't talk too much about points 20 and 21, and that's about the strategic asset allocation target. So the January meeting of the local pension committee sets the strategy for the fund. Point 21 summarizes the changes that were made at that meeting. At 22 to 30, we're covering the fund's cash position and its alignment to that strategic asset allocation. Point 22, we note that the cash held by the fund is higher than the target. The target is 0.75%. The fund holds well in excess of 0.75%. It's around 9.4 at the minute. 23 to 30, however, talk to how we're trying to realign the fund and how we've got to a position where we've got more cash than we should have. We do have £900 million worth of commitments to private markets as we try and realign the fund towards private markets from public markets, and that's the reason why we're holding more cash than we should. We're trying to come away from these listed liquid areas and move towards some of these private areas, and that's why we're holding a load of cash, but we've got a lot of commitments out there to these areas, and we're waiting for managers to call that capital. We do have a cash flow forecast for the fund. Point 28 talks to that. We think that by the end of the financial year, we'll be towards 300 million. So we're looking to drop about 250 million in the next few months, or next half year even. Got a summary at point 30. We've summarized the table that's overleaf on page 225 into growth, income and protection. So they're the asset groups to kind of summarise the more granular level that you see over Leaf. And it summarises too that we're underweight those income asset groups. So that's property, infrastructure and credit in the main, 7.6 below the target, and the overweight is largely in cash. And you can see that in the table there. Any questions at that point?
Thanks, Chair.
Ryan, sorry.
Thank you, Chair. Bailiff, just one around the timescale. Is there a timescale set for managers calling off that capital, or is it just when appropriate? Because obviously that reduces the capital that's held because it's been moved. So is there a timescale set for managers to carry out that completed works, or do we just trust them to do it within a reasonable time frame without defining the word reasonable?
Yeah, good question. That's I think that's part of the problem. So what happens here is different managers and different asset classes have different periods of time that they're able to invest the capital. So there's things called final close, where every investor has to commit their capital. So that's the final close. So you do it by then. And then depending on which mandate you have, they'll have an investment period, which may run to 1 year after the final close, or 2 years or 3 years. So across all our private markets, we've got a whole swathe of variations in how long people are allowed to call that capital for. If they don't do it by the end of the investment period, they can't call it beyond that.
Sorry, Chair. The reason why I asked the question was that there wasn't a knee-jerk reaction to beating the deadline, and I think you've answered that, but it just supersedes itself because they weren't able to, which is a fantastic answer, and the one I welcome. Thank you.
Okay. Anybody else got any points? I've got a query which I wanted to raise. So just in view of the fact that we've got, as we mentioned earlier, about the move towards everything becoming pooled under the Fit for the Future by the end of March, when, if we're going to then make future investment decisions, are we still able to make those future investment decisions up until the end of March? Or when does that, come in where we then, everything has to then be decisions about, that the advice comes from Central to us about what we should be investing in. When is the implementation point? Is there a hard stop-start for that switch over, so to speak?
Okay.
Does that make sense?
Yes, I'll try and answer that best I can. So you're right about the 31st of March deadline. At that point, implementation, as it's worded within the consultation, moves to LGPS Central. The administering authority still has discretion over its strategic asset allocation and investment beliefs. So the January meeting that you're familiar with, where we have our advisors on what changes we may need to make to the shape of the strategy, that still sits with this committee. Investment beliefs still sit with this committee. Implementation, however, passes to the pool.
Okay, that's great. Thank you for that. That explains that. Thank you. Okay, so did you want to come? You haven't finished yet.
Yeah. Carrying on at point 31. So 31 to 36 covers fund performance at the 30th of June. We've got a table at point 33, which summarises returns for the whole fund. We've got a 1 year, 3 and 5 year there. So we've got plus 5.1, a plus 6.3 and a plus 7.4 over the 5 years. You'll note that we are below benchmark. Point 35 talks to the reasons why we are below benchmark, and part of that is that we've moved to tougher comparisons. We've had a tougher year as well. And then on top of that, we've got a really diverse mix of assets within the group, and I've got a whole slide here if people have got any questions on the 5.1% for the first year, mainly given we've got a reduction in our growth assets versus the benchmark, mainly global active equity. There's a global active equity fund and private equity. Both have significant amounts of money, and that final year hasn't been a great year for both of those mandates. We've also got some investments within the income group, namely within infrastructure and property and private credit, where we've got certain funds who aren't performing as well over this 1 year. Looking further afield, you'll see that some of these funds have performed really well over the 3 and 5 years. We tend not to focus on the 1 year, but given that it was at 5.1, I felt the need to make a comment.
Yeah, Paul.
I just want to know, it is interesting that we've missed our benchmarks, but our funding levels sort of skyrocketed too. It sort of feels a disconnect between those two sort of numbers.
So we've had a good experience over the period of time between two actuarial statements of 2022 to 2025, and you can see that in the returns that we've had over that period of time. So it's probably less of a disconnect as you see it. If you see the first year only, it's still a positive return, but over the 3 years we've done better than that. It's not the only thing that affects the funding level. So there's a whole host of other things that affect the funding level on top of just the investment returns. Okay, happy to carry on.
Yeah, please.
37 to 48 talks to the fund's private equity position. The fund currently has a PE allocation totaling nearly 400 million, or nearly 6% of the total fund. That's slightly underweight, and the target is 7.5%. So we're about 120 million underweight. 39 talks to our actual breakdown of that 400 million pound position. So you can see we're mainly allocated to a manager called ASP in there, but that's Adams Street Partners, and that's our legacy manager that we've used for many years until pooling came along. And then as pooling came along, you'll note we've got 3 investments there: Central Private Equity 2018, 2021 and 2023. The values are still relatively small. As we talked about earlier, we've allocated or committed more money than you can see in that table there. It's yet to be called. So, for example, the Central Private Equity 2023 fund, there's 80 million pounds committed there. So at some point over the next few years, we'd expect most of that money to be called. Likewise, with the 2021 vintage, 40 million pounds was committed to that one. And the final line there is a legacy secondaries manager, Patria, who we haven't invested with again, but they've done relatively well in the time we've had them. Point 40 talks to the framework, and you can see a table on the top of page 227, and that table there is a way to control the risk the fund takes within private equity. You'll note that we've got minimum and maximum targets for geography, life stage and origination, and we have an appendix in the paper that kind of explains in more detail what life stage and origination and those areas within them. So if you want to know more about what venture is or growth is or buyout is, we've got that within there. On top of that, we've also got LGPS Central, who are coming in on the next agenda item. We've got a large section, or a larger section than usual, for private equity, and their investment director is here, so we can definitely learn more about that when they're in the room. The last part here I'd like to talk about is pooling progress. Simone talked earlier about how much the funds progressed in terms of pooling. So 49 and 50 talked to that. And we now have over 4 billion for the first time invested with LGPS Central. So that's about 59% of the total funds assets. We'll hear from Central next agenda item regarding private markets in particular. So that 4 billion covers both public and private. They're here to talk about the private markets today.
Right, okay. Mr. Cartwright.
I'm going to have a go, Chair. I probably don't understand the question myself, so you might not, but I'm going to try. We had a presentation some time ago from fund managers that were particularly good, achieving really excellent results because they invested in new technologies or more volatile stuff, particularly IT and that. The question relates around, do we have any fund managers that are currently part of our scheme that aren't going to transition over to LGPS Central, that aren't represented in LGPS Central over that 100% transition? So you get what I'm saying? Is there anybody we're involved with at the moment that won't actually be part of LGPS? So we'll have to disengage their advice and their portfolios because we won't be able to, quite frankly.
I'll have a go. I think what you're saying here is, are we losing any of our existing managers as we transition? Short answer, no, in the short term. Where they are in private markets, the right thing to do would be to let them run off. So for example, we have investments with infrastructure managers who are working on new technologies. They are really long-term investments or products, 15 years in some cases. They're in private markets in illiquid assets, so they're hard to come out of. So short answer, we'll still have access to those managers. Central will just do the oversight for those managers rather than the administering authority.
Well, I think, if I can just come in there, I think the point is that there is a bit of flux here when, there are some unknowns at the moment. And what I'd say is that all the members of Central and the yet to soon to be admitted additional 7 or 8 members of Central, new members that Central's going to be taking on, will all be keen that, the same point. We'll all be looking for the same point, that if they've got existing investments that are performing well, they don't get lost, if I can put that in inverted commas, along the way somewhere. I think that's probably what you're asking is, we're not going to lose sight of, we're not going to lose things that are doing well because of this shift around, which none of us particularly wanted, but we're being forced to do. But I think all the schemes, from having been at the annual meeting on whatever day, Tuesday it was, in Wolverhampton, lovely. I think, they all have a similar thought, same thoughts on these sort of areas, very similar thoughts. Thank you. Right, I'll take Councillor Whittle. Good morning, Jeff. Can you hear me? It's your question you would like to ask?
Good morning, Chair. First, my apologies for not being there in person today, but I have a bit of a virus and I'm sure you wouldn't want me to share it with you. My question is, I'm just, in view of, there was some concern about the 100% transfer for all the fund's assets to be managed by the central pool. I'm just wondering if we've made any comparison in terms of returns between the funds which are still being managed locally and those are being managed on our behalf by the central pool. Thank you.
Okay, thank you. Bullish, can you answer that?
No, we although we could probably work it out, we don't have a single answer for everything Central manages versus everything everybody else manages. We've got subtotals for every single fund that Central manages for us. So it's within the appendix. We can see that. We've got manager reports. In fact, we also have a total Central manager report within the appendix, which is right towards the top of the pack. We'll check what agenda item it is in a moment. So you can see every fund that Central manages for us and their returns.
Is that something you'd be able to send round to us after the breakdown of that question afterwards?
Yeah, the other point to note is it's not exactly like for like. We can't compare the returns that Central have for us versus what the other managers have. We've got a lot more private market managers in our legacy group, so we'd expect a little different returns mixed, as you'd expect, whereas we've got a lot of active equity and passive equity with Central.
Is that something you'll be able to do a little note round after the meeting?
Yeah, we can certainly put together a report that shows returns by fund, if you like.
Okay, so we'll get something round to everyone after the meeting. That's great, thank you. Nick?
You reassured us about the existing investments, but is there any sort of scope? Most of our private equity is with Adam Street Partners, who've done very well for us, and we've got a bit of an inside track with them in terms of new funding within that. Are we going to lose that effectively when Central take over everything, or is there any scope to have them included within Central?
That's a really good question, actually. So it is Central's discretion to choose best in class for a asset class. So, the committee could decide that we keep a 7.5% allocation to private equity, but Central can then decide which managers to use, and Adam Street can still be one of those managers.
On that, it is likely that Adam Street will go. Adam Street's what's called a fund-of-fund manager. So they don't actually do any private equity investing themselves. They just find other managers to do it. So they charge quite a bit for that pleasure. So it's very, very likely that Central are going to say, they'll move Adam Street out. And because they're getting all the funds in, they're going to have the scale to actually go to private equity managers directly themselves. So I would expect Adam Street to be one that winds down. But you're going to see more of the kind of the mainstream sort of private equity managers come in that Central will be able to go directly to.
Does that answer your question?
It answers my question in terms of, we are going to lose them. It's a question of, is that the best thing or not? I don't know.
That's the conundrum, Nick. And at the end of the day, we haven't got a choice.
No.
The government is. I mean, it's even worse for some of the other funds that are administrating authorities that have been told they've got to come out of their existing pool and find a new pool to join, and some of those, I mean, most of them are, I wouldn't say are terribly happy about that, because it's even more destabilizing for them than it is for all of us. Bullish.
Can I just quickly come back on that point, in the sense that Adam Street is a fund of funds manager and they charge us slightly more than, as Declan mentioned, than Central could, but the kind of underlying private equity managers that Adam Street invest in are still available to Central to invest in.
Yeah, that's a good point. Sorry, Mr. Cartwright again.
Thank you, and don't want any misunderstanding here. So I asked the right question. So are you alluding to the fact that Adam Street might not be supported by LGPS Central, but their actual overall funding strategy might be adopted, albeit with a different name, if you like, because they've done so well, excluding Adam Street? So basically they're a byproduct of the government's 100% target. It's understanding how they're affected by the government transition, which obviously affects, because we made the good choice in the first place. Let's use the words like that. But they're going to be seriously impacted then if LGPS effectively take over their role, but just with a different name funding strategy that very looks familiar to what they did because it was so successful. Choosing words carefully there.
It's probably fair to say, if we sort of wind back time, the reason we used Adam Street was because we're a relatively small fund. So what you want to do with things like private equity is try and spread your investments, not just things like sort of globally and across different industries, but also in time periods. And private equity is kind of particularly sensitive to that, where you have really, really good years and really, really bad years in terms of when you make those initial investments, depending on the kind of the economic cycle sometimes, which you don't always know in advance. So if we were to try and do that as a fund, we'd be investing with lots of managers on a very, very small scale, and some are just basically turn around to and say, you're not worth the while. We're going to play with the big boys, as it were. So we just wouldn't have been able to get a good spread on our own. Hence, it's worth the cost with somebody like Adam Street, who charges fees, but also quite significant performance fees. So what Central will do is absolutely rational. And if we were a bigger fund like somebody like West Midlands, we'd have probably made that choice in the first place anyway, to sort of go direct to the bigger managers, whether it's your sort of your KKRs, your people like that, and just actually sort of directly invest. But then, as has been alluded to, just sort of create either that global strategy or whatever with them. So I don't think we'll lose anything out. As Central play it right, have a reasonable sort of strategy and reasonable kind of manager selection. There's no reason why they can't kind of do significant lower fees than Adam Street gets in the sort of performance return. So I think what Central are going to do is absolutely rational, and it's not one of the areas that should concern us too much, to be honest.
Yeah, thanks for that, Declan. And just, if I may, just from the chair, just say, at the end of the day, as we heard earlier, our strategy, the investment strategy, what overall classes that we're looking to invest in, that will still stay with the administrating authorities, as I've understood. And equally, because we are a shareholder of Central, equal shareholder with all the other administrating authorities, we are able to hold the board to account for their performance And at the end of the day, we need them to perform really well, because at the end of the day, we're here to provide benefits for our beneficiaries, and they need to maintain, a track record. So if they're not performing, we will be holding them to account through regular oversight, through the shareholder oversight process that goes on. And so that's how it will work, but in a way no different to what happens here now. And there'll be regular, as we do now, we have regular reports that come to this committee and to oversight what's going on, etc. So I think, it's going to be, a transition, but I think overall it'll probably stay very much business as usual, really, I think, to some extent. Anyway, we've got a recommendation, which is the committee has been asked to note the report and presentation. Is that agreed? That's great. Thanks very much. And the next item is the LGPS Central Report. Just gone to get them. They're down the corridor. If anyone wants to have a quick stretch, you can do. Thank you. So we just have a quick 5-minute break, adjournment. Thank you. Okay. Right, okay, everyone, thanks very much. We're going to restart now. And so just been around and introduce you all to Jane Atkinson from LGPS Central, who's the Chief Investment Officer. And we're now going to move on to, say, item 10, which is the LGPS Central report and presentation, which is pages 241 to 246. And I'm just going to hand over to Bulish, who's going to just do the introductions of the report, etc. Over to you. Thanks very much.
Okay, thanks, Chair. Purpose is to provide the committee with an update on the outcome of the government's Fit for the Future consultation, pooling matters, and includes a PowerPoint presentation from LGPS Central. For our newer members, the fund is a stakeholder in Central from two perspectives: a co-owner of the company, so a shareholder alongside 7 other owners, and it's also a recipient of investment services, so we're a client as well. Point 10 talks to the government's Fit for the Future consultation, the focus of which was to look at how tackling fragmentation and inefficiency can unlock investment potential for the scheme through asset pooling, enhanced governance, and strengthening the focus on local investment. Point 11, A to C, describes the changes in more detail. To enact those proposals, government have introduced a pensions bill. Government will hope to achieve royal assent by early 2026. As highlighted in June, 8 out of the 8 existing pools, of which Central is one, support from the government was expressed for 6. The other 2 pools, which represented 21 administering authorities and LGPS funds, the government have invited them to talk to the remaining pools to find a new home. They've asked for an in-principle decision before the 30th of September, so the end of this month, and any shareholder or client agreements to be signed by March 2026. Happy to hand over to Central at this stage if there's any questions, unless there's any questions.
Okay, before we do, I just want to welcome Nadine, Gillian, Jazz and Jane to our meeting. Thanks very much, welcome. Might be helpful if you just explain what you all do and everything, because we've got a few new members here as well who won't necessarily, they're still trying to understand what LGPS Central does, and also some of you are new to us anyway, so we've not met you before either, so that'd be helpful. And then just to go ahead with your presentation, that'd be great, and then we'll do, it may be that there are questions that arise, and we'll do those hopefully at the end, I hope. But Martin?
Sorry, Chair, I don't want to get off to a negative start because I fully welcome the report and LGPS Central, but I'm just looking at the slide there and I'm just trying to understand what the rationale behind for professional investors only is. Is that kind of making a statement, or does it need to be there? And I'm a bit concerned about that because I would think we are, and I just don't know why that's there, Chair. And I don't want to get off to a negative start, but I'm sure someone. I'm not liking what I'm looking at there.
I'm sure someone can explain that. There's probably some regulatory reasons for that. But Nadine, did you want to? I can see your hand on the button. It's a bit like University Challenge this, I'm afraid.
Yeah. So
pass this to the buzzer.
Yeah, it's normally required for us to do as part of the FCA regulation, so that nobody takes investment advice from this on an individual personal basis. So in case we say something that someone relies on and use it on a personal capacity, it's not investment advice for example, a person in this room on an individual basis that they can then rely on. So it's required for us to put that as part of the FCA.
Yeah, because you'd have to follow a different process to get that advice.
Exactly.
Because we're a private individual.
That's right. We're not regulated to give advice on an individual basis.
Okay. Happy with that, Martin? That's why it has to say that. That's why it has to say that. Okay.
It's not our wording, by the way. It's the FCA that asks us to put it off.
We're not going to argue with them. Okay, all right. So do you want to go ahead and do the intros and kick off with your presentation? That'd be great. Thanks very much.
Thank you, Chair, and thank you everyone for having us here. My name is Nadeem Hussain. I'm Head of Private Markets here at LGPS Central. Been with the company for about 5 years, and my background was very much an investor into infrastructure for most part of my career. I spent 14 years in London, not only sort of investing in infrastructure, but also advising various managers, etc., on how to invest in infrastructure.
Good morning, all. Is that on? Yeah. Good morning, all. My name's Jazz. I'm an investment director for private equity at LGPS Central. Previously, I was at the West Midlands Pension Fund pre-pooling, looking after the private equity portfolio there. And I'm a local lad from Wolverhampton, based in the West Midlands, and doing investments for West Midlands, followed on into Central, and now with pooling, expanding, looking forward to enhancing that role further.
Good morning, everyone. Very nice to be here. My name is Gillian Day. I lead the private credit asset class within private markets. I joined LGPS Central last May, and my background is in private markets. I was at JP Morgan for many years in the US and here in the UK. I was at RBS, and most recently I was at Phoenix as head of private credit.
Hello everyone, thank you for inviting us here today. My name's Jane Atkinson, I'm the Chief Investment Officer. I've recently joined Central. Previously I was Chief Investment Officer at Unilever for about 8 years, and then prior to that I was at Nestle, and then I spent the first decade of my career in investment consultancy. So I was an investment consultant and actuary, and I've worked for Aon and some other consultancy firms as well. Thank you for inviting us here today.
That's great. So I'm just going to turn the lights down for so we can see the presentation easier, because there's a light shining on it. But whenever you want to start, please go ahead. Thank you.
Thank you, everyone. So the agenda for today is very much cover the 4 asset classes that we have within private markets. And for those that need a reminder, that's private equity, private credit, infrastructure and property. I think the last 2 are sectors that probably are well known to everybody, but private equity and private credit are probably less known. We'll go into a little bit of a deep dive. Jazz will go into a bit of a deep dive into private equity. Gillian will then cover credit before I look at infrastructure and property. So on slide 4, this is a summary of the investment funds that we have set up for our 8 partner funds, our existing 8 partner funds at LGPS Central, in which Leicestershire have invested in. You'll see across here there's various sort of long names, but in effect there's one property fund, which is a direct property fund in which we directly acquire commercial property. 2 infrastructure funds, which Leicestershire have committed to, 3 private equity funds, and in effect there are 3 funds which do the same thing but are in different years. So you'll see 3 years there, 2018, 2021 and 2023, in effect 3 vintages, so 3 years that we've been deploying that same strategy. And then Gillian's been particularly busy doing sort of 5 private credit funds. Again, they are vintages, so in effect what we do is we launch that same strategy after investing that capital over a certain period, again in subsequent years. The column shows the total partner fund commitments in these strategies as of March 31st. And the reason it says as of March 31st is because typically in private markets, you get financial accounting and valuation data that runs a quarter in lag. So you'll see the data to the 30th of June at the end of September, which we're currently working on and will present to partner funds. Leicestershire's commitment to those private markets funds is a total of 1.2 billion. Just to note that is as of 31st of March, because members may be aware that Leicestershire have committed an additional amount, for example, to infrastructure in the most recent quarter, which is not reflected as of March, but it would be reflected as of the 30th of June. The one nuance with private markets relative to public markets is that often when our partner funds make a commitment, we make a sub-commitment. That capital is not necessarily drawn straight away. So by that, I mean, for example, if we're invested into an infrastructure project and committed to funding, let's say, a toll road, for example, that may take time for that capital to draw. So because the toll road may, for example, be in development, and that takes a number of years. So when that commitment is made by Leicestershire, it's not always drawn straight away. So you'll see on the slide the drawn percentages, which vary depending on how quickly the capital is drawn. In some asset classes, it is a bit quicker. So, for example, if we look at the core, the second row there, the core plus infrastructure. Now, core plus infrastructure is actually assets that are already developed that we're investing into in order to get long-term income. They do tend to draw capital a lot quicker because they're invested into assets that have already been developed in effect. Whereas you'll see on the row after, row 3, which is a value-add infrastructure, which is often investing into greenfield assets, i.e. assets are going to develop. The drawdown percentage is a lot lower, and you'll see, for example, 39% there. The other thing to note about private markets is it's often a long-term asset class. So in effect, the performance will be delivered over time. Now, by what do I mean by that? So in effect, if you acquire an asset or a company, you wouldn't necessarily expect it to be valued up in the quarter or within a year a significant amount of return, because often there's a development play or value-add initiatives that are going to be developed. So we're investing over the long term in order to get those returns. So you'll see a bit of a mixed picture in terms of the current IRRs, and that's often because those funds either, one, haven't drawn the capital, or two, because they're at the earliest stage of their fund life, which can be sort of 10, 15 years plus. On the next slide, I'll quickly talk about sort of RI and how that's integrated into our processes. Many of you will be aware that RI is integrated into all of our asset classes, and we do an independent review of all the investment funds that we invest into to ensure that they operate to a certain level of RI that we expect. Now, why do we expect that? We expect that because, in effect, the managers that invest into these assets, we expect them to be good stewards of those assets, not only in terms of looking at the environmental aspect, but also the social and governance which does become quite important. And the reason for that is because we want to ensure that, for example, services and materials, for example, that may be used in the investments that we own are being sourced in the right way. There's no employment laws that are being broken by, for example, companies that use, for example, child labour in certain aspects, and also to ensure that the governance of those assets is looked after over a long term, and not just when we're making an investment. So when we look at RI, we look at the people, the processes, ensure that there's good transparency on those assets over time. So it's not just on day one when we're investing into an asset. It's over the lifetime of an asset, because we're often long-term stewards of those assets. I'll pass on quickly to Jazz to go through a bit of a deeper dive onto private equity before coming back on infrastructure and property.
Thanks, Nadeem. So private equity, probably a good way to think of this is when you look at your typical high street or even your local industrial estate, there's lots and lots of private businesses there. And some of those businesses need capital, some of those need capital and professionalism to help them expand and grow. And that's where private equity comes into play. Private equity as an asset class has been around for a long time, but the term itself, certainly when I first started at West Midland Pension Fund, it was still called venture capital. And our portfolio was actually called unquoted because it's not publicly listed. It's private. So there's a lot of shoe leather that's worn out finding these attractive businesses, whether on the high street industrial sectors, off the beaten track. And then when they find these investments, managers will invest our capital, the capital that we provided for them, into these businesses to help those businesses grow. So there's a couple of nuances there with that structure. One is there's no public information about the valuations of the businesses, to the point that Nadine made regarding valuations. But also the capital that gets deployed is quite lumpy, so it's difficult to know when a deal is going to transact. So although we make our commitments within our investment period, the underlying managers will call the capital as and when they're needed. There are some nuances within the industry now where, with the availability of debt, they're using subscription facilities to fund those businesses initially, and then calling the capital from us as investors much later as well. So there's a little bit of a disconnect between the portfolio building up and the amount of capital that's actually being called from us as well. But nevertheless, it's an asset class where capital is provided to help these businesses to grow, and for which we'll get a return. On slide, I think it's on page 8. Yeah, you can see the life cycle of a company, and at different stages, depending on where the businesses are, their need for capital and expertise varies. There's no one manager that does this whole spectrum. You'll get managers that focus very much at the smaller end of the life cycle, a lot more in the mid-market, and some more that do it at the larger end. And we focus where we think we can get the best risk returns, which is mainly around the mid-market. We will be launching a venture strategy, which will focus more on the smaller end of this, but our core focus with buyouts has been on the mid-market. And this is typically businesses that sometimes have been led by families and founders, and then there's a next step change, whether it's passing it on to the next generation, or they want to expand out into new geographies, new regions, launch new products, or just need help to professionalize the business to take it up to the next stage. And this is where the managers come in. Some managers will focus on certain sectors in the mid-market buyout, so some might only do consumer and retail, others might do industrial businesses and business services, financial services. So there's different managers, and we'll select those managers that have the best track record for deploying capital into their sectors. Part of the reason why private equity exists, on the next slide, is that the vast majority of businesses, like I said, if you've got any high street in your local industrial estate, they're privately held. And there's actually been a growing trend now where the number of businesses that are publicly listed is actually declining as well. The private equity industry has grown, and some of those managers now also are taking some of the publicly listed businesses private as well. That typically happens a bit more at the larger end of the scale, but it's happening a bit more frequently in the mid-market as well. The benefits of private investments is that you can take a longer term view. You can take our investments are into managers where there's going to be a 10-year fund life. They can take a business private or invest in a private business to begin with, and take a long-term view to invest in the resources, invest in the management teams, deploy new capital expenditure. Whereas on a publicly listed market, they're quarter-to-quarter valuations. You're under pressure to make sure that the next quarter's figures are better than the last quarter's, just so the share price continues to pick up. Those might not be the better long-term solutions for the business. So there are little nuances between what the public markets do and what the private markets do. And there's listed there some of the sources of fundings that we use for. On just a point on the last bullet there, it's well documented and well proven that venture firms, whether they're focusing on technology or on life sciences, are actually coming up with more products, more innovation, faster than big research and development departments of large organizations. A classic example is Pfizer down in Kent, which had a plant, a research and development plant. They shut it down in Sandwich, and because they just were not developing any drugs or new devices fast enough, because it's bureaucracy, it's the slow culture, the decision-making process takes a long time. Venture firms are much more nimble. They're pretty much flat organizations. They've got the capital. They're looking to make investments. and they deploy the capital in a nimble way. They'll react to competition, they'll react to market dynamics, and they have a better success rate of getting new products and new devices to market. We've backed a manager in our portfolio, which you have exposure to, a UK manager that in the last 15 years has pretty much developed and got approved 15 drugs, so one a year, whereas Pfizer, with their big facility in Sandwich, wasn't able to do that. And it's a similar story with the tech. You'll see lots of technology, new inventions coming along, the likes of Microsoft, Apple, they'll gobble them up. But this is where we tend to get our returns. So even at the smaller end of the scale, there's lots of good returns to be had, as well as the more established businesses. So at Central, on the next slide, the managers that we get access to, we have long relationships with some of the best managers in the world, some of the top quartile managers, the most highly ranked ones, and some of the managers that we've got more recently access to, in the likes of Olympus, Berkshire Partners. They regularly feature on the top quartile listings of global ranked managers. How we manage to get access to these managers sitting in Wolverhampton? We've been doing this a long time. At West Midlands, I've been at West Midlands for 20 years, and the program had started before that. Like I said, when it wasn't even called private equity. And some of these managers, they appreciate the fact that we're not fly-by-nights. We come in, do a vintage or two, and then disappear again. We're there for the long term. We see the benefits of our long-term program. And the reputation has got out that, you know, we're serious investors. We've been doing it a long time. We know what we're doing. And that sort of begets more and more relationships coming to us, contacts coming out to it, reaching out to us. So we've been able to get access to some really good managers, but also to really good co-investments as well. That's another part of our strategy. And like I say, and this is across the globe as well. So we, through our mistakes that we've made in previous incarnations, we have a global mandate, but we don't do the riskier end of the markets. We did Latin American investments when we were at West Midlands. We don't do that here at Central. We didn't get compensated for the additional risks that we were taking in terms of the political nature there, the currency risk, and we were getting better returns just here in Europe, the US, and in Asia, developed Asia. So we don't look for emerging markets or frontier markets, those kind of things. We can get as good returns just doing what we do. With the approach that we take, with it being in-house, based in Wolverhampton, we're a low-cost centre, and we get the benefits of, you know, taking away that additional layer of fees, because private equity and private market classes generally are more expensive than the public markets because of that hands-on approach where the managers are going out, finding businesses, getting the right management teams in, putting in the capital and growing those businesses. It is more expensive, but you get the better returns. But by taking out the layer of cost, we try to keep it as low as a lower cost class of asset class as possible. And then the final point there on the co-investments, as Nadine mentioned, the cash flows are a bit irregular. They can be lumpy. With co-investments, the capital gets deployed immediately. This is when you're investing directly into a business that the manager has found. So they've given us their details. They shared their research that they've done on it. We will then invest in that business alongside them, and that capital gets called straight away. So that's a little nuance with the co-investments. On the next slide, you can see some of the performance here. And like Nadine mentioned, the asset class is a long-term asset class. The first vintage is called 2018, but we actually started making investments in 2019. So we refer to it as the 2019 vintage. So for the benchmark performances against the comparable funds that were raised in that same 2019 period. A lot of these businesses now are in the value creation and early part of their liquidation phase. So we're starting to see the distribution starting to come through on these. And that's because some of these underlying businesses now are being held for 4 or 5 years and are getting to that point where they're getting to that maturity level where there's interest, inbound interest, as well as looking for exits. The exit markets are a little bit soft at the moment, but we expect that to clear up next year as markets pick up. On the 2021 fund, this is still very much early in its investment phase. And then the more recent one is the 2023 fund, which is where we've just completed our program there. So it's really very early on that one. And just in aggregate, the 120 million that Leicestershire's got with us represents about 10% of the capital allocated to the private markets. On the next slide, this is the amount of capital that we've committed in sterling, and it does vary a little bit. On the last chart I just mentioned, we just made our final commitment on that one, and we've actually taken the commitment levels up to 105%. So we've adopted this deliberate over commitment policy because the underlying capital from the number of managers doesn't always get called in full. So we might make a commitment of 25 million to a manager, and they might only call 23 million because they've reserved some, and then they don't need that reserve, so they release it. So just to try and get as close to 100% called, we overcommit slightly. On the next slide, we give you a little bit of a further insight into the 2018 programme, and this is just a diagram of the top 10 positions that we've got in there. Just to highlight one, which is Medline Industries there. This was it was the largest privately owned business in America that provided products to the healthcare industry. It was family owned, 45 years in the family, and they were going through that generational change where the first generation had taken it on. They were now coming up to retirement, and they were looking where did they take this business next. And it was actually a very, very big business. But like I said, one of the largest private businesses. We've had it now in our portfolio for a couple of years, and it's doing really well. And now the next option there is to exit it, and there are moves to list this business towards the end of October. And if it does, it'll be the largest IPO in the US this year, just to give you a sense of the scale. But again, we've got access to these deals, and we've actually got a co-investment with this one as well. So that just gives you a little bit of insight onto this. And as I mentioned, we expect to see more and more distribution starting to come through from these investments. But the portfolio is really well diversified across sectors, managers, geographies, and industries. On the next slide, it's a similar story with the 2021 vintage. This one is still a little bit earlier. The number of portfolio companies has increased, and it will continue to increase. Because some of these managers are still in their investment phase. Within the top 10 listing here, we've actually got 3 of these businesses that we've got a co-investment with, and 3 of these businesses, Sagility, VFS Global, and Right at School, have already, although they're very early in their fund holding periods, have started to generate liquidity for us, and they've given us back distributions already. This is not something we typically expect. When we make a commitment, we expect the manager to deploy their capital in the first 5 years, grow the businesses, and then exit in the sort of 8-9 year period. Because some of these businesses are more attractive, they're able to refinance them or sell down partial stakes as well. So we get a return of capital a little bit quicker. The portfolio isn't immune to what's happening globally. So one of our businesses, which is listed in India, has been impacted by the tariffs that Donald Trump introduced. There's not a lot of exposure to the tariffs themselves, but market sentiment caused it to dip, which it has bounced back since. So these are part of the nuances of the public markets as well. On the next slide, you can see how the portfolio is building up, and we're up to about touching 70 businesses at the moment. In the fullness of time, we expect this portfolio to have somewhere around about 120 businesses. But then they'll start to tail off as those businesses start to exit off as well. Then just on the 2023 vintage, this is the last commitment that Leicestershire has made to us to date. The one that's in white there was the one that we were taking to committee, and I'm glad to say we've had a committee approval for that last week, and we just signed the deal yesterday. So that investment now is committed and closed, and that completes the program for this 2023 vintage. And you can see it's well diversified by geography, US, Asia, and Europe, and it's also split well across the market segments that we favour, sort of the growth and small end of the market, the mid market, and then we've got the one investment in the large cap, which is with a manager based here in the UK, where we've had a long relationship with them. They gave us a co-investment even when we weren't invested with them because they appreciated LGPS Central as a desirable partner. The Bullish has heard me say that phrase many times.
Nice quick question. Is it worth just explaining what co-investment means? I think we've used it numerous times and some people may not know.
If you'd like to just, you're going to explain that. Yeah, that's great. Thank you.
Yeah, so when a manager is looking to make an investment in a business, sometimes the capital requirement is, say, just for argument's sake, 100 million. And for their own portfolio construction, they think 80 million would be best for them to put into that business. So that 20 million of that's available, they'll offer it to their partners, to their limited partners. Some limited partners say, no, we don't do co-investments. Some will say, yes, we'll do it, but our minimum check is also 100 million. So that's too small for us. We've kind of positioned our program to be in that sweet spot with managers where 15 to 20 million is a very desirable amount, because they don't want to have lots of 1 million co-investors, and they don't want to have an investor that's putting in more capital than they're willing to put in, which we wouldn't want to do either as well. If the manager's only putting in 5 million, we wouldn't want to be putting in 15. If the manager's putting in, say, 80, which is for their portfolio construction, we want to see that that's the right size for them. It's the right size for us. But we will co-invest with top performing managers that are good with those sectors and that business is in the sector that they, where they're strong at. And then also we have access to those reports that they've commissioned when they're doing their due diligence to see whether there's anything that we would think, actually, you know what, we think this environment is trickier than what you're making out, or there's a lot more hard work that needs to be done to get this business up to the level to get the returns that you're talking about. So we will co-invest with managers when they're doing a deal. Sometimes we'll do the co-investment as they're looking to do the deal, which is much harder work, because we're waiting on them to get the reports. The timeline is more stretched. The financing isn't finalised. The reports aren't all being commissioned. Typically, we then like to do the deal once the manager's already made the commitment.
Just to add, co-investments are often direct stakes in a particular company, whereas what Jazz has been talking about in terms of the other funds, it's going into funds that invest in companies, whereas co-investments are direct stakes into companies. And the key reason why we do that, or two key reasons why we do co-investments, is one, we don't pay fees to managers. So we're often saving 1.5+% on fees that we normally pay through a fund. And the second reason is that we often get that capital deployed a lot quicker as well. Because if there's a business that they're looking to buy, then we know that actually it's going to complete if everything goes to plan in terms of the due diligence that we'll undertake. And as a result, the capital will be invested straight away.
On co-investments, how do the exits work? Are we sort of partnered up with the primary investor and we exit at the same time as them, or?
Yes, we are. So we would insist on the drag along rights on that. So we wouldn't want to be holding on to an investment when the manager's already exited it. We have looked carefully at, because sometimes when a manager is selling a business, they're selling it to another fund, and sometimes we might have an exposure with that manager as well. And sometimes we do look and say, well, should we continue our journey with this asset, or do we think, actually, you know what, the environment has changed, or this manager is not as good as the manager that we originally backed for this particular investment. This manager is probably going to rely a bit more on leverage or on other factors where they've got a little less control. So we will make that decision consciously, but we would go along with whatever the manager is doing.
Okay, thank you. Carry on, please.
Thank you. The next couple of slides. The next slide is just on the 2023 fund. Just a little bit more details here. The first bullet point there is probably a little bit of something that's quite unique, actually. We talked about, as Nadine mentioned, the capital gets called much later than when the businesses have actually been invested in. And in this scenario, we made a commitment to Olympus last year. They've gone out and invested in 2 businesses. They haven't actually called the capital from us because they've used one of these debt facilities that's available in the markets at the moment. But they've had some distributions back. So you've actually got a DPI, this Infinity, because and an IRR, because they actually haven't called any capital, but they give returned some already. Now, again, this is not normal, but it is one of the nuances that, so you're getting money back before you've actually invested in it. The others are more standard. The investments are being made and the capital will be called in due course. But this is just to highlight that the portfolio is building up nicely on the 2023 vintage. And just on the final slide on private equity, this is for the new 2025 fund, which we're in the process of launching. As I mentioned, the 2023 vintage is now just been completed this week. We've held workshops with partner funds, all the stakeholders. We held a survey, we held the workshops, we developed the investment case for it that was approved. We're now at the business case, which we'll be taking to our IC next week. And then we'll share that with partner funds to then launch the next vintage. And pretty much it's the same strategy that we're looking to do, focusing on those core mid-market managers where there's a lot of value add, where they're just not relying on leverage, but they're genuinely value add, and that's a core part of our strategy on that. There's no question.
You can only have 2 microphones on at a time, so sorry, you just need to turn them off. That's all. Thank you. Sorry. Who's going next? Sorry.
Shall I go next?
Thank you. I just wanted to flag just as an observation. You may wonder why there's investments in different vintages. Vintages just means year. And the reason for that is because when one comes to exit these investments, sometimes you can exit an investment when it's good market conditions, so it's easy to get out of the underlying companies. Sometimes you can exit and it's bad market conditions, particularly if there's recession and so on in a particular market. So pension funds, when they invest in private equity, they tend to like to invest in multiple different years and multiple different vintages, so that there's a smoothing effect in terms of not being exposed to one particular year when one disinvests. So I just wanted to flag that, because I know we've talked about lots of different vintages, and you may be wondering why on earth have we got all these vintages. So I thought I'd just flag.
Thank you.
Thank you.
Gillian, is it now you? Yep. Oh, sorry. Did you want to do that now, or do we? No, we can do it now if you want. I just thought we'd try and get through the presentation and then do questions at the end. Well, we can either do questions as we go along, or do you want to do them at the end? Yep.
Do them now. Yeah.
Yeah. Okay. So, sorry, I didn't see you, Nick. Okay.
Thank you. In terms of private equity, in terms of the timings of it, because IPOs seem to be ground, certainly been reduced within that. Does that mean that the timing, which sort of say 7 to 10 years, is now expanding, so that the time period that the investments would be over a longer period?
Yes, it is. Absolutely, it is. What we're seeing as a result of that is managers are saying, well, actually, I've got a really attractive asset here. In the normal course of business, I should be looking to exit this, but it's not, the market isn't right for an exit. So what they're doing now is creating these continuation vehicles, which are actually quite attractive as a new investor coming in, because you've got a lot of visibility on the deal. The manager wants to continue to hold it in their portfolio because they still think that they've got a lot of runway to help the business grow further. So it's throwing up new niche opportunities like that. In certain parts of the markets, IPO are still open. In India, the IPO market has been very active. I think India has been the most active globally for this year and last year. The US is just starting to open up, and which is why the Medline one is now considering, because they were looking to list actually last year, but they put it on hold because of the turbulence, and now they're looking at it again. But that is a big business, so that is an IPO exit only route for them. Yeah, it very much so.
Okay. Yep. Dr. Bloxham.
Thanks, Chair. Yeah, I don't know, this may not be relevant, I guess. The fit for the future stuff and the requirement for local and regional investment, is that something you could tell us any more about? Is that something you started working on? I noticed a lot of the underlying companies a lot of them were international, quite big. is it going to change the funds that you have to invest with, and are there enough of them out there if all the council's funds are going to be doing this? And have you heard much gossip in the industry about new providers going into that area?
Yeah, absolutely. So yes, we've started doing some work on local investment, really on the back of what the government sort of said initially, to try and help the market to kind of define what is local investment, i.e., you know, is it within the administrative authority? Is it within the pool? Can it include investments that are potentially outside the geography region, but actually still bring a benefit or an impact to that particular region? So I think we've been able to get that definition now kind of cemented. What we're doing in the background is kind of looking at what opportunity that we could bring to our partner funds that works for all our partner funds, i.e. establish which sectors can you address local investment through, i.e. which private market sectors. And in essence, it's all the private market sectors. It's quite easier. It's easier to do in property because actually in local and you know, in almost every region there's a housing need. And often that is only really accessible through a private market solution, i.e. helping a small house builder build homes, whether that's through providing equity or potentially providing credit or a credit facility to help build those homes, and then so you don't take on the risk of actually holding those homes and having to sell them over a number of years. So you kind of get your return as a debt product. With what we've started doing in the background is kind of looking at what that product would be, i.e. how the partner funds could invest into, and our solution that we've still to be developed, but it's very much going to be sort of sector agnostic to try and access those other opportunities that may be available within our regions. So, for example, is there venture opportunities within the Midlands or in our existing pool opportunities, but also are there other infrastructure opportunities? Now, in our regions, we're kind of blessed with land, for example, rather than the southeast, which is, you know, very, very, very developed. So actually there's, as a result, more, for example, infrastructure opportunities that could be available, whether that's sort of renewable opportunities or other potential transportation assets. And what we started doing is actually speaking to the managers that actually currently operate within the regions, because there are those managers that do focus on those local opportunities. In the past, they've probably been, in all honesty, a bit too small for us, but actually what we're able to do now is to be a bit more of a significant investor in those, to try and understand how they're interacting with local growth plans, for example, to take advantage of those opportunities. I think our approach initially will be to work with those managers that are operating in our regions. Often there are smaller, but some of the larger ones do recognise that change in the market. So actually they're open to creating a solution that works within our regions as well. That in our mind gives thought in terms of how that proposition is being developed. I think what we'll do is continue to work on that solution. But what I would say is actually there's not going to be, I don't think, you know, a shortage of opportunities in our partner fund regions. As a pool, we're probably going to be a little agnostic on whether it's one partner fund region versus another. I don't think we can say, you know, we want everything in Leicestershire or everything. I'm sure you guys would, but you know, we're going to be sort of more agnostic in terms of those opportunities. But it is something that we will continue to develop over the coming weeks and months.
Okay, thanks for that. Are you happy with that? Yeah, that's great. Okay, is anybody else? I'm going to go with Vipul and then Mr. Cartwright. So Vipul.
On the sort of changing strategy around interacting with regional funds and how they interact with things like local growth plans, is there anything sort of more you can say about that, please?
Yeah.
So how that sort of strategy has changed. So you said those investments or those funds might have been too small before, but that's sort of changing now. And could you speak through that a bit more?
Yeah. So when I said they were too small, often when Jazz, for example, is doing a private equity vintage, he doesn't want to invest in a local venture fund, because if he's committing a certain amount of capital, it may be that he's the largest investor in that fund. And what we don't want to be is that largest investor and take on all the risk of that fund. So that's what I meant in terms of us being significant. But I think actually as more gets allocated to local opportunities, those funds will naturally get larger in size as well. So then we won't be as a significant investor. What we don't want to be is taking on all the risk as that one main investor in a particular fund. In terms of the growth plans, I think what we're trying to do at the moment is work with the combined authorities and build those relationships in terms of understanding what they're looking at in terms of opportunities. To give you an example, we spoke to the West Midlands Combined Authority. It was a bit easier for us to speak to them because they're on our doorstep, to understand sort of what their model is in terms of the opportunities and the capital that they have in order to invest in opportunities. Now, often it's a different type of capital. It can be sort of more grant-like capital, so actually they're not looking for a return. So it's working with them to try and make those opportunities more investable for an institutional investor, because ultimately we still need a return. We still need a return to pay pensions. So we're not a grant-like capital. So it's unlocking those opportunities and trying to get them to think in that way and trying to structure deals in that way, rather than it being sort of grant or quasi-grant like capital.
Okay. Martin?
Thank you, Chair. I've got one on infrastructure, but I'll wait till I hear the presentation before that because it may well be answered. But we've previously been asked, as an administrator, obviously, the definition of local under what it's going to be going forward. You've just alluded in your presentation to you're looking at the definition of what local is. As I don't need to declare to you now, but the question relates around everybody's going to be asked the same question, and I'm sure that the answer is not going to be unified across everyone that's asked that question. So I'm trying to understand when there's no unification across everybody's asked the answer to that specific question, how do you get to a compromise, or do you even need to get to a compromise, or can you keep within whatever we define as local, which may or may not sit alongside what you define as local?
Yeah, so just to clarify that, so we had a session a couple of weeks ago where we were discussing this, and our summation of that was we thought that the pool area would be our kind of would be what we would call local. Obviously preference for Leicester and Leicestershire, of course, and Rutland, but ideally, if that's not possible, then within the pool area. Obviously the pool area, as mentioned, as we all know, is expected to expand. We can't say it's definitely going to expand yet because those decisions legally haven't been made yet. So we just have to be mindful of language that we're using. But if all goes as thought, then we will have a very significant geography covering much of England, and therefore the opportunities, as you've mentioned, will be great. I think one of the concerns we have, and was mentioned, which I don't think anyone's answered yet, is too much money going to be chasing too few attractive investments? There's lots of opportunities, but they're not necessarily that attractive or the right size. So what I suppose, and if the other pools are all going to be doing the same thing, as well as private investors and the other market investors, then is there a potentiality for the pricing, the value that you're having to go in at, being too high? I.e., we're going to be, basically forcing the values up because there's more money chasing things than there is available. I think that's the concern that we have. I'm sure everyone else has that concern elsewhere, but I'm just wondering how we kind of make sure that we're not overpaying at the entry point and we're not then getting less return later on. Does that make sense? I hope it does. But if you also can, Martin's point as well, that's great. Thank you.
Yeah, absolutely. And I think in terms of local, our definition is similar, if not the same, as what you're saying in terms of it's within our partner fund regions. I think the only slight change that I would say to that is if there is an opportunity that is a few miles outside the geographical border, but actually, I don't know, it's a rail link, for example, that helps people travel into Leicestershire and actually helps the Leicestershire economy, and you can see that impact analysis. I think that's where we would slightly try and expand that, but those opportunities are going to be sort of few and far between in all honesty. So I think we're aligned in terms of that definition. In terms of pricing and sort of, is there going to be a lot of capital chasing those opportunities? I think the baseline on any sort of local investment that we do is that actually fundamentally those opportunities, the returns would have to still stack up, even if it was an opportunity that we were looking at in any other part of geography, part of the world or part of the UK. Just because it's local is that we won't, necessarily accept a lower return. Fundamentally, those returns would have to stack up for the relative risk that we're taking. And just because it's within our pool region, we're not going to say, well, actually, we're willing to accept an X% lower return, because how do you define that lower return? The one thing that I would say is slightly different when we're looking as a local pool at local opportunities is we're always going to have to report back on what's the impact of that particular opportunity, i.e. how many homes, for example, has it created, how many gallons of water has it saved, how many jobs has it added to the local economy, etc. So that's where we're not just sort of looking at financial returns, we're also going to have to define the impact of those opportunities.
Okay, happy with that, Martin?
Not really, because our fiduciary duty is returning the maximum to the pension providers, the holders of the scheme. So, they're not interested in future job growth because they're retired. That's a blunt way of putting it. Our obligations are slightly different, but accepting the fact that you have to go along with government legislation, and that's where the two collide and a magnet detract from each other. It'll be what it will be, but yes, it doesn't help in providing that fiduciary duty obligation we're under, because we're not looking at employment necessarily. If employment comes as a result of it, then great, but our fiduciary duty is maximum return for the investors.
Yeah, thanks for that. Has anyone else got any points at the moment they want to ask? Jane, you wanted to come in there?
Thank you. No, I completely agree with you. I think ultimately it's going to be important to be open-minded to the types of investments and not get too constrained, because you're absolutely right. It's about the expected return at the end of the day. So this is not, we're not doing this for, philanthropy reasons. This is, members' pension, and it's incredibly important that we get the expected return. And therefore, we can't be too specific in relation to particular types of investments in a particular area. One needs to broaden out and think, well, actually we can invest in property, and we can invest in private equity, and we can invest in private credit and infrastructure, so that we can actually have exposure to those different types of asset classes. And they'll also be lumpy as they come along. Not really a technical term, but sometimes we'll get more investments in a particular asset class than another one, depending on the year. And I think therefore we need to be open-minded in terms of where we go in terms of those investments and those opportunities, because you're absolutely right. It's the return that trumps everything else, and we want a good return for the level of risk that's taken, which is another important factor. And the other important factor, which hasn't been spoken about yet today, is around reputation. So that's something we're very mindful of. Yes, there will be opportunities out there, but we must protect the reputation as well of our partner funds that are invested in this space.
Okay, well, that's great. So if we can carry on with Gillian with your presentation, we've got about another 15 minutes or so for this kind of your slot.
For this
so for the whole of your sort of section. So
Okay,
if we, just to give you an idea, we have been on this quite a while,
Yeah,
so
okay.
I know we've got questions, but we're kind of hopefully halfway through now. So
Okay.
over to you. Thank
I'll
you.
move along
Thank
rapidly.
you.
So now
Thank
we're
you.
moving from the world of private equity to the world of private credit or private debt. And what is that? So that is when you are lending and the investments, each of the investments, as it's private, needs to generate what we call an illiquidity premium. So that is essentially a little bit of extra interest that you get because you are making a long-term buy and hold investment, which you're not expecting to sell. So we're looking for that illiquidity premium, that little bit of extra return that you can generate. And then it being lending, unlike the world of private equity, we are not looking for growth. We are not looking for upside. we are looking to get our money back at the end. So that's very much about protecting the downside of the capital that you are investing. So moving on to page 20, this shows all of the partnerships, all the vintages that we have done to date within the credit portfolio, and these cover three major types of lending. So lending to companies, first of all, also lending to real estate, and lending to infrastructure. So it's sort of a range of different underlying investments. The key thing about all of these is that we are trying to make the portfolios as diverse as we can, because by making them diverse, we are again mitigating the risk that we're taking. So what you see here, each of these funds has a lot of sub-investments within them. It's probably around about, I would say, 700 sub-investments. So they're really quite diverse, and they're diverse by different metrics. So they're diverse by geography, they're diverse by sector or industry, they're diverse by the size of the company, obviously by the manager, and also by the level of risk that is being taken. So what you see on here, you've got the first two, which credit partnerships 1 and 2, those are both direct lending. Those are both to companies, lending to corporates. And then credit partnership 4 is actually what we call real assets, which is lending to infrastructure and real estate. And you can see, for example, at the last two columns, you have a net target. So that's the amount of return through the interest that's being paid over the course of the investment, and then the performance as well. Overall, we have for the 2021 vintage about 16 managers across around about 19 sub-funds. And if you just move on to page 21, you will see the top diagram shows what's been committed. So you, as partner funds, have committed money to us, and we have turned around to the market, and we've selected a number of managers that you can see here for each of the different sleeves. So you can see it's pretty much fully committed for this vintage. And then the lower diagram is what's been drawn. So that's actually what's the money that's been put in the ground by the managers. And that doesn't happen immediately, as Jazz was saying. That's a process that happens over time. We obviously want we want the managers to make the investments as quickly as possible, so they can quickly generate interest and be paying the pension obligations. But we also don't want them to invest too quickly and look to invest in anything that comes along. So with some of these, as you can see, that section where it says undrawn capital, that might be because it's a relatively new manager that we've just committed to, or sometimes in certain cases it might be that part of the market doesn't look particularly attractive, so the manager is perhaps taking their time in making the investment. If we move on to the next page, so this is very important for the credit portfolio. So you won't see quite this sort of thing in the other portfolios, but what we're doing here is we're monitoring the risk of the portfolio over time. All of the managers that we work with will assess their individual investments, and broadly they'll map them out according to where they think they are in terms of risk. So that's what you see down the right-hand side. So they usually use about 5 different risk ratings, and they look at them pretty much every quarter to see how the risk is developing. And we then take all that and we produce this where we can see over the years, this one begins in 2023, we can see how that risk is evolving over time. So this shows that the first two funds, the Credit Partnership 1, which is a bit higher return fund, and Credit Partnership 2, which is the sort of core stable or slightly lower return fund. How do they come up with the designations? I mean, they're monitoring the companies very carefully, and every investment that we do with the managers has a structural protection, which is a covenant or a number of covenants. So they are looking at financial covenants. They're looking at what the levels of leverage are, how much ability they have to pay back their interest, what the balance is between debt and equity, and they're looking at that every over time. And if they see those metrics sort of verging towards the limits that have been agreed at the beginning, then they might change the designation here. So this is what you'd expect. You'd expect a big green section. That's the sort of stable part of it. You might expect, as the fund evolves, to see a little bit more that looks yellow below plan, and inevitably you might see a little bit of the red, which is where they're concerned about the interest payment being challenged. But this is really important for a credit portfolio. And then the next 3 slides, we talk about the next vintage. So all of what I've said before is the prior to 2021 vintage, the prior commitment. But we're now, since October, we took commitments for our next vintage for 2024, which you've committed to. And we've been in the process since last year of looking across the market and selecting the best managers in each of the categories that we're looking to deploy. So on this page, we've just closed our first direct lending credit commitment to CVC, and so we say here why we've made that decision. Essentially, we look at we start with a very large list and we narrow it down and narrow it down and narrow it down, come up with the top one, and then go through a pretty rigorous approval process internally until we're comfortable in it, until we move forward and close the fund. And in CVC's case, we believe the reasons we moved forward with them were that they were very experienced manager, very long, operating the market a very long time, had a very strong track record, and they already had what we call a seed portfolio. So they'd already done some investments. We could see what the new fund was going to look like. And not to forget cost. So we negotiate quite heavily on the fees with them. We also get an aggregated reduction as an LGPS pool, which is good. So we're getting better fees through economies of scale of the pooling system. So CVC focuses on Europe, the European manager. We are looking, we've first of all looked at Europe. We are now looking at the US because our portfolios are diversified across different regions. We started with Europe and we've only just gone to the US because we felt what was going on was quite, the US was looking quite volatile or at least uncertain in the earlier part of the year. But we've got a better sort of view into how the economy is being affected. So we're now looking at the US funds. And then moving on to page 24, and now we're looking at the real asset fund, so back to the property and the infrastructure. And our first real assets manager selection is for Invesco. That is a commercial property portfolio, so they would be investing in things like logistics warehouses, possibly some retail, but a lot of industrial property, not really residential property. And again, we looked at things like the experience of the team, the track record on the other funds that they'd done, and sort of what the terms were, what their own commitment was in terms of money in the ground, and what their fees were. And then the last one that we are going to focus on for the 2024 vintage is for HSBC, and that is an infrastructure fund. And this one's actually called, it's called the Global Transition Infrastructure Debt Fund. So they're looking at things like the transition in energy that's happening globally. And they also have a slightly different focus. So they're focusing on the mid-market, so slightly smaller projects than perhaps some of the other infrastructure houses. And one of the reasons we did like this particular manager was that HSBC is a very large global bank, and we are getting the benefit of that global network and that sort of global footprint in order to be able to originate and to see all the opportunities as they arise. Also, very strong track record, and they also had some good seed assets in the pipeline. So that is at the end of my section. So I don't know if anyone has any questions, but I'm very happy to take questions.
Okay, Martin.
Yeah.
Thank you, Chair. Well, how do I put it without offending anybody? It's probably me. I probably completely misunderstood the figures, and I apologise if I have, because first time I've seen them and it's only on the screen. But the specific question I've got, Chair, is the 2021 improvement over target doesn't negate any of the other vintages. You know, that improvement doesn't negate against the vintages, previous vintages that have underperformed, and the likelihood of future vintages overperforming, unless I've completely misunderstood the figures, as I say, or the returns have not yet been delivered simply because they're not reaching that you talk on HSBC about being 6 years from end. Are all the gains more towards the end, so they've not been gained up to yet? And I make that point because from what I saw, the targets hardly set the world on fire for returns, for risk. And I completely might have misunderstood it, and I really apologise if I have, but I feel I need to ask the question, Chair.
Okay, Gillian, are you able to answer that at all?
So with HSBC, we have not begun deploying yet, so we would not. We haven't closed that one yet, so that's what they're projecting. So it wouldn't be something that we've done yet. But with the other vintages, so in each one you have a target return, which may not look like a particularly ambitious one, but remember it is lending and it's not equity. So a high return for credit would be 12 to 14%. That's quite a good interest rate. I mean, if you were thinking about paying that, you'd think that's quite a lot. And that's at the end of the credit spectrum where things are fairly bespoke, and you might be lending to a privately held company or a family-owned company where you might be supporting their growth. So that's the upper end of what we would do, 12 to 14%. The core part of what we do, where I think you have the largest investment, is in direct lending, where the target return is about 6 to 8%. And that's the biggest, the deepest part of the direct lending market. So that actually is a lot better than it used to be, because we're in a higher interest rate environment now. So we're actually getting the benefits since 2022 of interest rates going up, as I'm sure everyone's aware. Yeah. So it's better than it was. Yeah. Well, I think that's all relative. We do judge the risk according to the return. So remember, you've got a very, very diversified portfolio.
Yeah. I'm just trying to remember, is our overall return on investment 6%? Is it that we're looking for?
6 to 8.
Yeah, for the pension fund in general, it's not far off that. But I think what we'll need to really understand here is that these are credit investments. So, you know, in the event of any defaults, we get paid out first. So therefore, we're not looking for great returns here. We want our money back at the end. So you want your principal back, and you want your
diversification. Yeah. Okay. All right. Is any other points on this part of the presentation? No. Okay. We'll move on then to.
Sure. Infrastructure. So conscious of time, so I'll try and go through this as quickly as possible. But within infrastructure, we have two funds that our partner funds can invest to, and to note that these are open-ended funds. And by open-ended, it means that actually they're long-term funds that actually have some liquidity. So it's not just investing in a fund. At some point, you can have liquidity, i.e. redeem capital. The thing to note about the infrastructure funds is because they're open-ended, capital from our partner funds could have come at many years over the last few years. And actually within the 5 years, we're still within that 5-year investment period that we're still deploying capital that our partner funds have allocated to us. So actually the performance only begins after sort of the 5 years and when that capital has continued to be deployed. There's two strategies here, Core and Core Plus, which is very much sort of brownfield operating assets. These are assets which are, have been that don't necessarily require a lot of investment, maybe some expansion, etc., but not necessarily building from ground up. Whereas value add and opportunistic infrastructure is more that sort of taking on that greenfield risk, i.e., developing those assets. Now, at the early stage of these funds, I think it's important to know that we often go through what's called a J-curve effect, and that's the same across all of private markets, in that you're deploying capital and you're incurring expenses to develop those assets. So at the point of developing those assets, you're not going to get a return. So you often get what is called a J-curve, and over time those assets deliver a return when they start operating and giving cash flows. The things to draw out here is that, again, that sort of point that I made earlier in terms of the draw numbers. In Core Plus, we're finding that as we make that commitment, the capital is being called a lot quicker because it's invested in those operating assets. But in value add opportunistic infrastructure, that is a lot slower. So we're getting a slower drawdown rate over time, and you can see that is 39%. In regards to the performance has been, it's not a fixed target that we have because it's open-ended. It is a CPI-linked performance, and we've gone through a period where it's a high CPI, and as a result, the performance here looks as though we're behind target. But to know that the performance number only starts after a rolling 5-year period, and we're only 3-4 years within these funds. So after year 5 is where we expect that to be meeting performance once we hit year 5. On the next slide, this gives you a brief overview in terms of the managers that we've selected in each of those portfolios. We've got a mix of open-ended funds, so i.e. funds that we invest into that are open-ended as well, so that we can have that liquidity in the event that partner funds want to redeem in our funds. There's a mix of funds there across the infrastructure subsectors, so everything from social infrastructure, transport, digital, but also renewables and energy transition assets as well. What we want to do is create that diverse portfolio, so we're not reliant on that one particular manager to deliver those particular returns. It's a similar story in the value add infrastructure fund. Naturally, this is the more riskier end, so there hasn't been as much allocations, and when we made our first commitments, they were a bit smaller of size. So you'll see, for example, CIP, which stands for Copenhagen Infrastructure Partners. That is a smaller amount of commitment because at the time we had fewer commitments from our partner funds in order to make those sub-commitments. But more recently, we've been able to size our tickets a bit larger. And what we've done recently since March and when this report was made, we've now committed to CIP's next infrastructure vintage, which means that actually that portfolio becomes a bit more balanced. I'll move on to property. So I mentioned earlier that we've got a direct property fund, and this is us directly acquiring properties as opposed to through managers. It's a UK direct portfolio fund which looks at the typical commercial property sectors being retail, office, industrial, and what's called other. What this fund does, we work with a property manager that we've appointed, DTZ, to identify properties that we want to invest into across the UK. We have a minimum requirement that actually half of the properties need to be outside of the southeast and not just all in London, so that we have geographical diversification. On average, at the moment, the fund is only 130 million. I say only, but it's 130 million pounds worth of commitments, and on average, we're buying properties in the region of sort of 20 to 30 million. As the property grows, then as the portfolio grows, then we'll start potentially looking at larger properties. To date, we've committed to 2 industrial properties and 2 retail parks, which are most of those are sort of Greater London, but we've also got in the pipeline a hotel opportunity that we're looking at, which is in the north part of the UK. And also some additional retail units within the Midlands and slightly outside the Midlands regions. So diverse in terms of geography as well. This is a relatively newer fund that we have set up. So to date, we measure our performance against what's called an MSCI property index. So far, we're delivering above that property index. The property index, as many of you know, has not been the most overperforming of indices, as the property sector has continued to struggle. We're pleased that to date we are 2.5% versus that index of 1.3%, so slightly further ahead. On the next slide, we give an example of the retail park that we've acquired. This is one in Maidstone in Kent, quite an attractive retail park that has in Kent and in Maidstone, which is a sort of strong commuter town. It's a multi-let property, so we've got a number of tenants there, including you may be able to bring it out in the or see in the picture, but or recognise the brands. But the brands that are there include sort of Dunelm, Home Bargain, Dreams, etc. Those are often leased out on long-term lets. Finally, what I'll quickly bring up is the Leicestershire property portfolio. Members will be aware that this got transferred from Leicestershire's incumbent property manager to DTZ, who we've appointed to look after the existing properties that Leicestershire held directly. We're in the process at the moment of inspecting each of those properties to develop that sort of strategy, and that will be formally communicated in the future to the pension fund and the committee.
That's great. Thanks very much. Martin, did you have a question?
Thank you. Yes, in terms of looking specifically at property investment, there's two opportunities, isn't there? There's the opportunity to buy the property itself, a whole retail part, and own the buildings, infrastructure, we call that. And then there's a second opportunity, asset building, in being the landlord of all of those buildings. So just trying to understand, do you only invest in the property itself and then have a landlord effectively lease out all the individual units, so your exposure there is nil, but your return is nil too, because obviously you're getting the investment off of the infrastructure being the building itself. So there's two opportunities: the infrastructure, the building, the fabric of the building, and then there's the leasing off of the individual units. Do you have a combination of both, or do you just specifically specify one?
Yeah, it's both. It's both. So we'll buy the building and then it'll be leased out, so we get the leasing income as well.
Okay, that's great. Anybody else got any points on what Nadim's just been through? No, I think it's very, very comprehensive so far. Okay, that's great. Okay, so we're at the end of the presentation. That's really good to know. Not because we're are there any other queries, comments that members have got that they want to raise now? Martin?
Just one understanding, I alluded to it earlier and I was hoping it came up really in the infrastructure. So infrastructure is a really difficult one, particularly new infrastructure, because obviously all your investments is early days. They rarely ever run, and it's not a criticism, they rarely ever run to time and they ever rarely run to budget because of massive pressures that are on that. So I'm just trying to understand how you smooth out those really bad early days. I know it's a long-term investment and eventually it pays dividend, but those early ones are a problem. And I was going to quote, just because to make it easier to understand, and it's not a criticism of any particular project, but when you look at something like, say, Skye Bridge, the Skye Bridge was an investment opportunity that a lot of people will have taken up on, and then it produced a toll that you talked about. But eventually they decided that they got the money back, so we removed the toll, and now people drive across the Skye Bridge for nothing. So there is no yield there now as a result of that. And I'm just using that as an example. So how do you, very briefly, smooth out those two anomalies, really, those early disappointments in cost because the world's not perfect, and also a change in, it's easy to understand with the Skye Bridge, if the
it was always set out to investors that at some point it will become free. So you know what you're dealing with. But equally, some of this new infrastructure will be chargeable at the early set, and then sometime down the road, pardon the pun, might become free, and then that yield's lost. That's the easiest way I can put it.
Okay, are you able to
Yeah,
answer that?
absolutely. So to answer your question in terms of early infrastructure when you're investing into it, so I used to invest in infrastructure directly. What you often do is try to pass on some of that risk on to whoever's developing that asset. So you have in contractually set out that this is how much we're willing to pay to build that particular infrastructure asset. And in the event that there's overruns or there's delays, then there's a mechanism there such that they compensate you if it goes over budget or it's delayed. And that's what often you're able to do on certainly sort of private infrastructure where you've got that control with the underlying developer, whoever that may be. So it's about selecting the right counterparty, but also getting those sort of contractual protections such that you're not exposed to huge cost overruns, etc. So that's quite key. I think where infrastructure, and it depends on where you operate within infrastructure because of various different sectors, a lot of those sort of costs, etc., are now a bit more understood relative to the earlier days. So if we look at a wind farm, just to make it easier, 15 years ago, it was a bit more difficult to sort of understand what those costs are, but it's now a well-established infrastructure asset such that you know how much or have a very good indication of how much those are going to cost. So that sort of helps smooth that volatility in the earlier years. In terms of your point on is an infrastructure asset then what happens when it becomes almost redundant or in that respect? A lot of the social infrastructure assets, there's often conditions associated with those in that if it's done in conjunction with a government or a government-backed contract, at the end of the life or at the end of a 20-year period, it has to be returned to the ultimate owner, which may be sort of the government, right? And there's conditions associated with that in that it has to still be, maintained, kept, etc. Because often, as a private investor, you're funding those on behalf of the government, and the government are paying for it over a longer period. So you ensure that actually at the end of that period, there are protections in which you have to maintain that asset and it has to be available to use because often infrastructure assets are long term, as you point out.
Okay, that's great. Thanks very much. So I think there's no other comments or questions. So the committee has been asked to note the report and the presentation. Is that agreed? That's agreed. And I'd like to thank Nadeem, Jazz, Gillian and Jane for coming to today's meeting in your very detailed presentation, but also very important for the committee. And I've no doubt we'll see you all at some point again in a future meeting. But thank you very much for coming over and your time today. Really appreciate it. Thank you. Okay. Just going to have a short pause while we let you leave, and then we're going to move on to the remaining items in our meeting. Thank you. Okay, thank you everyone. I'm conscious of the time, so we've got a couple, three more reports, I think, which we've got, which is the we've got the risk management, internal controls, pension fund budget monitoring and responsible investment update. So we've got we've got one chunky item there, I think. So Bulish, over to you for the risk management and internal controls. This is item number 11. It's on pages 247 to 256 of the agenda. Over to you. Thank you.
Chair, in the interest of time, would you mind if we take this one read and move on to the next two? Sorry, I'll take any questions. Sorry, take any questions.
Yes, I was just going to say the recommendation for those who haven't is that we're asked to note the report and approve the revised pension fund risk register. That there are 2 or 3.
There's 6 changes. Some of them are
changes to the risk register. They are in the report. But if anyone's got any questions to ask Bulish now, has anyone got any questions? Councillor Denny.
Yes, thank you, Chair. Just generally, and how much of our investment is in passive funds compared to the more volatile areas, just because that involves risk management?
So that phrase, if we're applying it to across the whole portfolio, I'll have to get back to you. But from an equities perspective, we have about a target of 41% for equities. All but 12% of that is in passives for the equity portion.
Okay. Are there any other questions on the risk report? Otherwise, as I say, the committee's been asked to note the report and approve the revised pension fund risk register. I'm happy to move the recommendation. Councillor Grimley, Mr. Grimley, second. Is that agreed? Everyone's agreed. That's great. Thank you. So move on to item 12, which is the pension fund budget monitoring report update at pages 257 to 264. And over to you. Thank you.
Thank you, Chair. Purpose is to update the committee on the pension fund's budget and the forecast for 25-26. Won't go over the part about Fit for the Future. I think we've covered that today in many points. So if we go to point 10, important to note that the pension fund's budget is independent of the council's budget and its finances are managed separately. Now, if you move to the table at point 15, the last 2 columns on that table shows the original budget and the new revised forecast. There's a 0.8 million difference between the 2 numbers. So the budget at 25-26 was 61.5 and the forecast is 62.3. The main change has come from the Fit for the Future changes, and you'll note that the LGPS central line, which is kind of in the middle of that table there, has gone up by about 0.6 million. We've also taken time to reforecast the investment management expenses, which you see in the top third of that table as well. Happy to take any questions at that point.
Martin.
I'm sure we have, Bulish, but is there been representation made to government about the Fit for Future costs actually impacting on our costs as everybody's in the same boat? I mean, I know McLeod, we're expected to absorb that, for instance, and it just seems it cuts up a bit rough with me personally, that all these things come along and then you have to absorb the extra costs, which means ultimately delivering elsewhere in order to absorb those costs, because this money doesn't come out of thin air, of course, and not least the stress on officers as well in doing it. But if we haven't, it would be certainly advantageous to make strong representation that the government should understand this, but I'm not sure they do, that when they make a change to the structure, there is a cost implication to it, both in terms of stress on officers and monetary. Thank you.
Thanks for that, Martin. I think, and I'm just going to answer as chair, and I think the point is that the money for the pension administering authority's budget comes from the pension fund. It basically comes from the contributions that employers make. And obviously county council is one of those employers, but then city and all the other things. So that's where that comes from, essentially, because it's held separate. It's a separate budget to the county council. So I think the problem with the increased costs from Fit for the Future is some of those costs, they're kind of they're kind of best guesstimates, if I can put it like that, at the moment. because a lot of it involves hiring extra staff at Central and the other pooling organisations, because they're going to have to start giving advice which currently they don't give, and that's one of the big problems. One of the challenges that they've got is to recruit the right staff in the right time frame, and all of that. So that's one of the factors that's driving the increased budget, and obviously we've had increased costs as well to deal with that as well. I think that's fair to say. So it is a matter that all the partners at Central, shareholders, I think it's fair to say they're all focused on with the board to say, you know, we need to be as sharp as we can with our costs and not overinflate anything. And I think that's fair to say. But Bruce, did you want to add anything at all to what I've said? No. Yeah. So I think that's where we are. But unfortunately, there's no money from the government. There's a surprise. None on offer. Okay. Okay, so this report is to where am I? I've lost mid-page there. We're asked to note the increased forecast for the current year, and that's it. Is that agreed? Agreed. Okay, that's great. Thank you. And so the final substantive item is the responsible investment update, which is on pages 265 to 290, and Kat is going to introduce this report. Over to you. Thank you.
Thanks, Chair. I'll only dwell on the area where we're asking for approval from committee on the kind of scheme member survey. So members that were around in June's meeting, we had a kind of an update report which set out the kind of key principles that we'll look to review the net zero climate strategy on, and they're listed in point 17. As part of this, I think it's also worth, just because the net zero climate strategy is up for review over in 2026, following kind of the previous engagement we had in 2022. So as part of this, it seems relevant to ask scheme members their wider views on kind of responsible investment matters, and then we can use these views when we're forming kind of pension fund policy and how we approach our investment managers and work with LGPS Central on the kind of factors that they are engaging with managers on. I will say when we're kind of when we come to look at the outcome kind of early next year, when we consider what the scheme members' responses are, we will have to kind of look at it not from a kind of simple majority view. The kind of legal guidance that funds have had is pretty clear that, you know, it's kind of what the majority of scheme members want or support, but also that it's not significantly controversial within kind of a minority, like kind of a group of scheme members. So we'll have to kind of view that appropriately. So Appendix C sets out the questions, and this followed the workshop we had with members a few weeks ago, which has already kind of been mentioned today. And then subject to committee's approval, we'll look to email all the scheme members that we have email addresses for. So that's about 40,000 out of our 100,000 members. And this is just where they've signed up for the scheme member self-service website. And then as part of that, we'll email our employers and ask them to advertise it with scheme members where they might not be signed up, and also advertise it on the pension fund website. So we've got the timeline in point 23, so we'd look to go from 8th of October to 17th of December. This also allows for us to kind of address this at the scheme annual general meeting on the 15th of December. And I'll leave it there unless members got any questions on the survey or kind of anything else in the report.
Okay, thanks for that, Kat. Has anyone got any queries, comments, questions they want to raise about this? Dr. Bloxham?
Yeah, thanks, Chair. Yeah, just looking at the survey, a couple of points. I just wonder if question 4 could perhaps be ranked from highest to least, would give a more useful thing. Otherwise you can sort of put very important for everything, and it doesn't really tell us a lot. So a ranking thing might be useful. I also thought as well, perhaps another option, maximising investment returns, would give us a clue of how much people value responsible investment versus fund performance. So adding that to the list as well, something, you know, obviously reword it if you want, but that might be handy too. And then I also thought question 6, sort of a slightly leading question there, setting them up, may make companies that do not adapt less profitable and so on. Perhaps again, an alternative could be that changes in government policy could make some carbon intensive companies more profitable, and it could make renewables companies less profitable. You know, if the government decided not to subsidise renewables and it decided not to penalise carbon producers, you know, and I'm not talking about the reality of climate change or the extent or anything like that, I'm just talking purely about government policy risk, that could also be a risk for investors. So it does seem to be sort of steering respondents in one direction. Thanks.
Okay, thanks. Kat, are you able to answer this?
Yeah, I can. I can discuss with the council's engagement team. I think the only thing, if we rank them, I guess it makes it slower for people to go through and answer. So that might just be kind of the question. But I get the point. Otherwise, people are just going to say, "Oh, yeah, we find it's all very important and it's not valuable or as valuable." So I get that point.
So I was just going to say the ranking can be done quite quickly if it's if it kind of blanks out other things once you've put a number in one of them. But,
okay, yeah, I'll sort to the team what we can do on that one. On the 6th, yeah, get your point. It's governmental policy either way, which is a risk to the fund. It's kind of that knee jerking between government policy and kind of changing. That's and that kind of uncertainty is like the big consideration, big concern. So we can look at the wording on that. Sorry if I missed one.
No, I think that was it, wasn't it? Yeah.
Oh, the investment.
yeah, maximising investment returns to be ranked amongst them as well.
So I think that's probably under question 4, probably.
Yeah, it's on question 8, but yes, recognise it's not, because these were more about kind of environmental, social and governance factors generally rather than kind of specific. But if members think it's kind of worth including, then we can do that. Yeah, it's on question 8, but that's specific to kind of climate risk.
Yes, it's 1, 2, 3, 1, 2, 3, 4. It's the 4th sort of box down. Prioritise financial returns by giving investment managers the freedom to manage risks. But what we're doing there is just asking people to select up to 3. Whereas what you're saying, Dr. Bloxham, is in question 4, we're asking people to rank whether it's very important or not at all important. Whereas what we're not actually doing is asking people to rank whether they think investment return.
One thing I would say from previous engagement response, because we have also have question 10 about do you have any other comments?
Yeah.
People that don't kind of think any of these are relevant when we had the survey before are kind of very. I don't think they have any issue with kind of declaring their view on that. So I think it would be picked up in other comments. But yeah, we can look at including that.
Does that itself not suggest that their view has been sort of missed out of the other questions? If they're having to add the comments though, and they've not been able to add them earlier.
No, that's fair. And I think we can add an option in that question 4.
Okay, I mean, just reading question 4 again, I'm sorry, I think I have some degree of agreement here. I think question 4 should, if we're asking people to rank a list of things which we think are important, then we certainly don't need an option to say none of the above. This is what I think is important. Because it could be that someone says none of those are important, they're not bothered about any of those. At the moment, we're asking people to just say, not to answer that as a question, but you could just have an option to say, none of these, I'm not bothered about any of these, I'm only bothered about investment return rather than how it's achieved. I mean, it's just, it might help get that answer rather than asking people to fill in a box, which then has to be then interpreted later. Just a suggestion.
Yeah, I suppose, I guess if members weren't interested, they'd just say not at all important. But I get the point. Making it easier to say we
I
do
think
not
so.
think these are.
Be simplified. Yeah, I think. Yeah. Okay. Has anyone else got any points? Mr. Councillor Denny, sorry, I'll get it right. Sorry.
You got it right last time.
I did. It's a long time.
Yeah, I haven't got the questions in front of me, but what's perhaps a question we should have asked our guests, but advocacy, companies that not necessarily in flavour of the month with people, if we've got a massive investment, is it important to you that we're there so that we can put pressure on them to move in the direction we want them to go?
Okay, Kat, do you want to answer that?
Yeah, I think that's a fair point. I think what would be helpful is if we bring Central back to kind of one of our meetings, we can kind of build it into the RI plan for next year about, and they can come talk to you kind of directly about where they see the impact and where they might find certain areas are less impactful than others, and where it kind of links back to that financial return. So, yeah.
Okay, Martin.
Don't disagree, and I agree with the sentiment. But if we go back to the original question that was asked right at the very start of the meeting, it says, we don't have any, we can't apply restrictions, sanctions, or embargoes on anyone or to influence policy. So, that partially does what we say we can't do anyway. So just tread very carefully on that one, because it can fall outside of what our not only our fiduciary duty is, but what our actual obligations are in any event. I'm not trying to be negative. It's just a very, very fine tightrope you're walking there to falling one side of complying or not complying.
Yeah.
Just a word of caution.
Yeah. Just to be very clear, as far as I understand, the pension for LGPS in Leicestershire included, we are not an activist fund. We're not an activist pension fund, so we're not led by activism, but we are led by legal frameworks and things like that. So, and corporate law and corporate governance, fiduciary duty and all that. So, Paul, did you have your hand up? Yeah, you did. I thought so.
Yeah, I think my comment is, I think it's quite hard based off the pensions workshop to encapsulate the questions and the comments that we all had. I think this is a really good survey, and it keeps it brief, and the wording's quite right. It doesn't get too overly complicated. So I think it's a very good survey.
Okay. All right. Anybody else? Okay.
Yeah. So, Chair.
Oh, sorry, Jeff. Sorry, didn't see that.
I've noticed that some of the proposals really are trying to steer people more to invite them to say that the return on investment is the most important thing, which obviously some people think that. Looking at question 7, it does actually invite people to say they don't agree with the fund's commitment to achieve net zero by 2050. But that is still a legal requirement on the whole country, isn't it? I mean, we do actually have a law that so maybe that could be added to question 7 before inviting people to say whether they disagree, just to remind them that is actually something that's been passed into law, and it was actually done by the previous government. That's my suggestion.
Okay, we can't say which government passed legislation.
No.
But
just making a political point. Sorry.
No, Jeff, I get where you're coming from. Okay, Kat.
So just to, I guess, clarify, I guess the pension fund isn't beholden to the same kind of what government enacts as law. I think when you look at the pension fund, because it's such a global investor, we're not just invested in UK companies, which may fall under government's kind of requirements. So this was a target which was set because that was what scheme members wanted and agreed with. So I think that's the basis of this target, and we just want to go to see do they still agree with that, and that's just part of the review of the net zero climate strategy.
That's right, and obviously the US is a huge market, and as President Trump has sort of made some changes over there to the framework, so, and 1 or 2 other countries similarly, so we have to be cognizant of those things as well. Okay, all right, so with the comments that have been made, the committee has been asked to note the report and approve the proposed engagement process with employers and scheme members. I'm happy to propose the recommendation. Can I have a seconder? Mr. Piper, thank you. Is that agreed? That's agreed. Thank you. So then item 14 is to note the dates of future meetings. They're before you there, so I'll leave those with you. And the only other thing we need to do now is also to note that the Fund's annual general meeting is on the 15th of December, and it is open to all scheme members to attend. I'll move on to item 15. Any other items, urgent items? There aren't any urgent items. So I'm now going to come to item 16, which is exclusion of press and public. And so I'm just going to read this out. I move the public be excluded during consideration of the remaining items in accordance with section 100A4 of the Local Government Act 1972 exempt information. Is that agreed? Agreed. That brings us to the end of the public part of the meeting, and the live stream of the meeting will now end. I'm just going to wait for Angie to confirm that's the case. Thank you.